Good morning, everyone, and welcome to our fall M&A Bootcamp. My name is Colin Main, and I'm a program manager with the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit dedicated to enabling entrepreneurs from all over the world to realize their maximum potentials and grow. As you may have just seen in the chat, the Nasdaq Center, along with our partner Mentor Club, launched a free mentor matching platform for entrepreneurs called Mentor Makers. You can create your own advisory board to guide and inspire you with in-the-moment mentorship from topic experts and professionals dedicated to providing exceptional mentorship to entrepreneurs across all races, industries, and geographies. So you can find or become a mentor today by using the link in the chat. Mentorship matters to all entrepreneurs. Their success is dependent on it. Now, none of what we do here at the center could be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, and BPN. We're grateful and humbled by their contributions. Quick housekeeping, we're going to be opening up for live Q&A at the end of each panel. So please submit your questions for us in the Q&A function at the bottom of your screen throughout the presentations. During these unique times that are still unique, we're curious on how sentiment is among the entrepreneurs that we work with. So we're going to start by taking a couple polls to let us know how you're feeling about your business right now. So I'm going to launch the first one. First of all, Q4, how are we feeling? Are we optimistic? Are we just in survival mode? How are we all doing? Thank you for your responses. Looks like things are changing mostly, but we'll hope that optimism's on the rise. All right. So I'm going to end this poll. Share those results. Thank you for sharing. Looks like optimism's at the top of the key, but totally understand there's still some survival mode and a little bit of anxiety out there. Our next poll helps us understand the programming that we should be offering here at the center for you in the future. So is it finance? Is it sales? Is it marketing? What's keeping you up at night? Is it scaling? So appreciate you guys giving us some of those poll results. All right. Looks like it's a pretty good mix here. So I'm going to end this poll, share those results. Looks like finance is the top of the key. So you're in the right place for the M&A Bootcamp. But I understand that scaling also is a challenge. One last poll. What side of M&A are you looking to learn about today? Are you looking to learn about the sell side or the buy side? So just let us know. And we appreciate you sharing your results with us. Ooh, it's looking like it's about 50-50, almost, which is great because we're going to cover both sides. I'm going to share those results with you all. So it looks like buy side's winning by just a little bit, but it's going to be a great conversation all around for this. So appreciate you all participating in the poll. Lastly, before we get started, let's take a look at the agenda for our day. First off, we're going to kick off the program with a market update and then a panel on the overview of the M&A market. Then we're going to have a quick 10-minute break and transition into our second panel, where our panelists will share M&A strategy for early to mid-stage entrepreneurs. Then we'll have another 10-minute break. And to round us out, our last session will cover growth through acquisitions, the buy side overview. So for those of you who just clicked the buy side, don't worry, we'll get to it. Please note the same Zoom link will be used for each session. So don't worry, if you have to drop for a moment, you can always come back. So without any further delay, please join me in giving a warm welcome to our first presenter to share the M&A market update. Mia here is a managing director and co-head of TMT KPMG Corporate Finance at KPMG. Me here. So looking forward to your market overview.
Colin, thank you for the kind remarks. Good morning, everyone. My name is Mihir Jabalia. I sit here in Silicon Valley and co-head the technology investment banking practice at KPMG. We'll go through a few observations of what we're seeing in the market. And if you go to the next slide, Isis, if you can move the slides. Perfect. So this is a quick snapshot on our practice. Just a quick background for everyone. KPMG is the most active advisor globally in the middle market. In the last 10 years, we have closed 4,500 plus deals, which surprises a lot of people in terms of the activity that we have done. Our clients tend to be founder-owned companies, venture-backed companies, and private equity-backed companies. We focus solely in the middle market, so generally M&A transactions sub 500 million, and we also do private placements where we raise growth capital for companies. If we go to the next slide, just a quick snap, one more. Yeah, perfect. So if you look at the M&A environment, I think we have gone through sort of a V-shaped recovery. If we were having this conversation about 18 months ago, right around March last year, there was a lot of fear in the market. I think people were concerned about how bad is COVID going to get. There was and since then, I think the market has rebounded quite spectacularly. So I think you're seeing across the board, if you look at sort of the total M&A across all sectors in the first 9 months of this year, it was about $3.2 trillion, which is 32% up year over year. Just in tech M&A, which all of us are involved with, in the M&A activity is over $1 trillion for the first 9 months of this year, which is approximately 50% higher than any full year in total. So we are sort of in a record environment. And so if you look at kind of what's driving this, number one, you have consumer confidence, which is significantly up compared to where it was about 18 months ago. You're seeing all the public indices trading at sort of record levels. You have interest rates, which are still at kind of relatively low levels. So you're seeing the strategics are generating a lot of cash and they're deploying that capital back in the M&A market. You're also seeing private equity firms which have raised a record amount of cash. And if you look at the private equity activity level in M&A, it is at a record level. I mean, if you look at just this in the first 9 months in tech M&A, private equity firms have hit have their activities up by more than 50% just this year. If you look at the mega deals, in the first 9 months of this year, there have been 247 mega deals. These are deals north of $1 billion. 247 deals this year compared to 56 deals in the same period in 2020. So about a 4.4x increase in the number of mega deals. And then if you look at the multiples paid for mega deals, it's up 11.3x enterprise value to sales in the first 9 months of this year compared to 8.4x in the second half of 2020. So across the board, sort of we are in a very strong environment in M&A. If we go to the next slide, if you look at the SPAC market, the SPACs have raised a lot of capital. If you look at just in the third quarter of this year, there were 88 SPACs which raised $16 billion, which was a 38% increase in volume over the second quarter of this year. In the third quarter, we also saw 59 SPAC mergers announced, which was down about 20% from the record number in the first quarter. And 71 companies completed their SPAC merger processes in Q3. Having said that, I think the SPAC market has changed. If you look at the SPACs which have announced a merger, they're down about 1% compared to the broader indices. PIPE investors are facing challenges and increased scrutiny. And so some of the SPAC merger activity has slowed down. However, we still think that SPACs will continue to remain a pivotal force going into 2022. And there's about $120 billion of cash on the sidelines from SPACs that have yet to announce a merger. If we go to the next slide, let's dive in and look at some of the subsectors. So application software continues to be one of the biggest sectors within TMT for M&A activity level. And if you look at the underlying drivers, I think we have gone to an environment where people have realized that remote working is here to stay. There will be some type of hybrid model. And what that has done is we are seeing sort of a significant increase in terms of cloud and SaaS with enterprises. The biggest challenge for sort of software development has been the lack of trained personnel. And so if you just look at someone like an Amazon, for example, they've declared that they will give free cloud computing training to 29 million people between 2021 and 2025. So Amazon is investing significantly into people getting more trained into software development. If you look at sort of the underlying trends in software, software is eating the world. I mean, if you're seeing every major company now investing in software. So software has gone broader than just software developers to companies, all kinds of enterprises, auto companies, healthcare companies investing in software. So you're seeing a rise in the digital of everything, growth of e-commerce, sort of an explosion in smart worker collaboration tools, and an increased adoption of cloud platforms. So if you look at all those underlying drivers, I think there is a lot of tailwinds in terms of the growth of application software, and that has turned into a pretty strong environment in terms of M&A market for application software. In the first 9 months of this year, about $240 billion of M&A activity announced in application software compared to 70 billion in the same period in 2020. So about a 3.4x increase in this year alone in application software. Through this year, through September of this year, there have been about 67 mega deals announced in application software, which is 2x higher than the total for 2020 combined. And also, if you look at the multiples, enterprise value to sales, this year alone, we are at 7.2x compared to 3.8x, which was pre-pandemic. So a significant uptick in the M&A activity level as well as multiples in application software. If we go to the next slide, cybersecurity is becoming increasingly an important sort of area within TMT. And if you look at sort of just the underlying facts on cybersecurity, the cybersecurity market is expected to grow to be about 400 billion by 2027. Just during the COVID environment, cybercrime is up 600%. So there is a significant amount of cybercrime, and you're seeing ransomware attacks happening every 10 seconds, which is kind of mind-boggling in terms of the amount of attacks happening. It's not just tech companies being attacked, you're seeing meat producer companies being attacked and having ransomware attacks. So you're seeing a significant increase in terms of M&A as underlying sort of activity in terms of cybersecurity. What that has done in the M&A market is, despite COVID, cybersecurity deals have significantly surpassed sort of deal values and multiples from 2020. And just in this year alone, in the first 9 months, 158 transactions in cybersecurity. Targets had a median of 9.9x trailing revenues for PE-led deals in 2021, which surprises a lot of people that PE firms would be paying somewhere close to 10 times revenues for deals. And this is up from 3.6x in the same period in 2020. A couple of notable transactions to mention. Okta, which is a public company, acquired a company called Auth0 for 6.5 billion at 43 times revenues. So Auth0 is doing about 150 million in revenues, trailing 12-month revenues, and Okta acquired Auth0 for about 6.5 billion. Thoma Bravo took Proofpoint private for 12.3 billion at 11.3 times revenue. So pretty much strong, very strong activity level, as well as multiples across the board in cybersecurity, both from strategics as well as private equity. And if you look at the amount of private equity dollars that have been raised and going after doing a consolidation in this space, there is a lot of dollars sitting on the sideline. We as a firm, we are involved in several transactions where both strategics and private equity firms are very active in this space. If we go to the next slide, another area which has a lot of activity is the whole area around data center hosting and managed services. If you look at the global data center and systems market, it's about 237 billion and kind of growing at 7% year over year. If you look at just the amount of data that's being generated, the amount of data doubles every 7 months. And so there is a increasing need for more data, more hosting and managed services. And if you look at the underlying trends, enterprises have had to adapt to a very different IT landscape in the last 18 months. Sustainability has taken sort of center stage in terms of being able to make sure to support a remote worker, remote customers, and being able to operate at internet speed. So that's creating a significant demand for increasing data center capacity. If you look at the M&A market in the data center and managed services space, just in the first 9 months of this year, it has risen to the highest level since 2016. And if you look at the dip in Q3, the aggregate deal value rose to about 25 billion year to date, which is 3x the amount of 2020. So significant sort of uptick again in the data center hosting and managed services space. If you go to the next slide, IoT, this is another area where we are very involved as a firm. And if you look at sort of the underlying trends, all of us, as you kind of look at where our homes are and where from even 2 years ago, the current stat is that an average household has about 50 connected devices, which is up significantly from 10 devices in 2019. And if you look at the amount of IoT spending, it surpassed $1 trillion in 2020. I think we are still in the very early innings of having IoT proliferate the enterprise, and especially in the connected sort of connected manufacturing space. If you look at the IoT market, it's expected to grow to about $4 trillion by 2025. And I think we are seeing a significant amount of M&A activity in IoT. And you're just building on the positive tailwinds from COVID, which has elevated the dependence on emerging technologies like IoT and 5G. Aggregate deal volume was about exceeded in the first half of 2020, first 9 months of 2021 already exceeded all of 2020. So significant sort of uptick in IoT M&A activity. I think you're seeing a number of sort of industrial companies acquiring both software as well as hardware solutions in IoT. So it's broadening more from consumers into industrial IoT. If you go to the next slide, just in terms of the overall M&A activity, I think we are in a sort of a Goldilocks environment where you're seeing tech M&A volume is up over $1 trillion just in the first 9 months, up more than 50% for any full year. You're also seeing SPACs, which have $120 billion of cash sitting on the sidelines and are yet to announce a merger. So SPACs will continue to be a force in the market. You're seeing private equity firms have raised a record amount of cash and are very active in acquiring platform companies as well as acquiring a number of sort of add-ons to their portfolio companies. If you look at the M&A activity done by private equity firms in the last year, 70% were add-ons to their portfolio companies. So private equity firms are super active in all of our processes. And then if you just look at one level below, venture capital firms continue to invest at a record pace, 58 billion invested in Q3, of which about 540 deals were late stage deals. So you're seeing every day, when you look at someone like TermSheet, you're seeing more and more deals which are larger being announced by growth equity firms and late stage investors. Within the technology space, we continue to think that there'll be robust activity in AI, data analytics, and the sort of cross-pollination between healthcare and IT. I think you're seeing a number of companies going after sort of white spaces, and I think there's a lot of activity both in technology and as well as biotech. So I think we have covered a lot of material in terms of a update on the market, and I think what we're seeing is the activity level is expected to continue at this pace, given kind of where we are. I think if you look at the overall sort of sentiment, you're seeing boards being more sort of optimistic about their forecast in the next 12 to 24 months. You're still seeing sort of a fairly strong economic environment, and excluding any sort of exogenous forces, I think we will continue to be in a pretty strong M&A market. So those are some of the comments that and observations of what we have seen in the market. With that, I'll turn it back to you, Colin.
Awesome. Thank you so much, Mihir. And we had a couple questions before we jump into our panel. One question is, which sectors of IoT Industrial are growing faster?
I think you're seeing a number of companies that are going after process manufacturing and discrete manufacturing, deploying IoT solutions across their facilities to bring sort of more data into their manufacturing. And I think you're seeing a significant growth in both discrete manufacturing as well as continuous manufacturing.
Yeah, and you mentioned the mega deals that have been going on, and you alluded to this a little bit, but is there still optimism for those to continue for the entrepreneurs in our audience today?
Yeah, I think you're going to. I mean, if you look at the mega deals, let me go back to my slide. I think we saw 247 deals, mega deals, in the first 9 months of this year, compared to 56 deals in the first 9 months of 2020. So it's a significant uptick. I think what's driving this is, first of all, you're seeing stock prices are, all the public indices are trading at sort of record levels. So there is a fair amount of optimism in the market. Secondly, the interest rates are still pretty low. So look, if you look at the strategics, which are generating a lot of cash, there is a desire on those firms to deploy that capital back towards growth through M&A versus dividending back to shareholders. And you're also seeing there's a fair amount of shareholder activism where investors want these companies to either use the capital or dividend back to shareholders. So if you look at all those factors, I think we are going to continue to see a fair amount of activity in terms of mega deals continuing for the rest of 2022.
That's awesome. And I'm sure we'll get into this later, but are there any drawbacks to these valuation multiples skyrocketing?
I think it's actually healthy for the market to see these multiples. I think you're also seeing a strong IPO market, a number of companies that have gone public and have done well. So I think from a company standpoint, I think there are certainly multiple options in terms of going public, and also that has helped the M&A market, whether it's getting acquired by a strategic or a private equity firm. So unlikely to change, at least in the coming months.
Awesome. And then one last question before we jump into our next panel. The attendee asks, are there any insights on the consumer side? We focus largely on enterprises, so don't have a view on consumer M&A, but happy to take it offline and provide any sort of data that you or anyone else needs. Awesome. Well, thank you so much for that market update, Mihir. Up next, we have expert panelists who are going to cover what the effect our current economy has had on mergers and acquisitions. Please join me in giving a warm welcome in the chat to our moderator, Melissa. She's a managing partner at 1863 Ventures. We also have Andy, who's a partner at KPMG. We've got Marty, who's a partner at corporate M&A at Wilson Sonsini. And we have Emily, who's a partner, the national group leader of M&A insurance at Woodruff Sawyer. Welcome, team. Melissa, over to you. So happy to have you guys. Looking forward to this one.
Thrilled to be here, and Mihir teed up what I hope to be is a great conversation around what is happening in the M&A world. I want to thank Andy, Martin, and Emily, myself, and I'm going to ask each of them just to share a little bit more about themselves before we get started, so you have some context for their comments. So Andy, I'm going to start with you. Why don't you tell us a little bit about yourself?
Great. Thanks very much, Melissa. My name's Andy Gersh. I'm a partner in KPMG's deal advisory practice based in Silicon Valley. Been with KPMG for just under 30 years and been providing M&A services for 25 and on the West Coast for almost 20. I support our sort of largest private equity and corporate clients on domestic and international buy-side and sell-side diligence.
Awesome. Well, thrilled to have you with 30 years of experience. I know you have a lot to share with this group. Marty, tell us about yourself and glad you could join us.
Thank you. Marty Corman. I'm an M&A lawyer at Wilson Sonsini in San Francisco. I've spent the last 30 years representing buyers and sellers in M&A transactions, mostly in technology and life sciences, going back to the early days when Cisco did their first early acquisitions, selling companies to them, then AOL Netscape and HP Compaq in the early days, and today as well.
I love the hashtag throwback, AOL and Netscape. I love that. You've got mail. And last but not least, certainly thrilled to have Emily join us. Tell us a little bit about yourself, Emily, and thank you for joining us.
Oh, my pleasure. I'm Emily Mayer. I'm a partner and I head up the transactional insurance unit for Woodruff Sawyer, which is essentially rep and warranty insurance, tax opinion liability, litigation buyout. And I've been working in that field for over 20 years, starting in the UK and coming over here to grow the practice.
Awesome. Well, welcome here. And obviously what you will hopefully hear are years of experience in this space. So really excited to get started. And my first question is going to be to everybody, just building off what Mihir shared in that we know that M&A is proving to be economical as well as rapid solution as we look at the disruption of COVID-19. So my first question to everyone, and Emily, we'll start with you, is how did this year start off in M&A for you and how's it looking right now?
It started off surprisingly busy. The quiet first quarter did not exist this year, and it's got progressively busier all the way through. It's I'm sure the other panelists have experienced it's been an insane year for M&A activity.
And there's something good about that level of insanity, I know, for
Absolutely.
business. Andy, what about you?
I'm going to repeat what Emily just said. I thought it was, if I look back a year ago, I thought it was busy around sort of September, October, and it couldn't get any busier. And I think it's doubled in activity since then. You're just seeing maybe less so on the corporate side, but on the private equity and the growth equity side, it's been insane. There's so much money. Debt's been so cheap that companies are willing to, private equity funds, sorry, and growth equity funds are willing to make bets that they may not have in the past, but given the money is essentially free to them, they're why not? And you never know if it turns out well.
Sure, risk tolerance is definitely changing and the markets are helping that. Marty, what about you? I'm going to take a guess you're busy, but tell us a little bit more about how busy you are and what you're working on.
Sure. I can't tell you exactly what I'm working on.
Generally.
Sure. Things are extraordinarily busy. Buyers are buying, sellers are selling. Corporates are looking, they're back in the market, I think actively competing with private equity purchasers. Private equity firms, as was mentioned previously, are not only buying platforms, but their portfolio companies are doing tuck-in acquisitions. Private companies who might not have previously considered an IPO are considering that and comparing that to potential SPAC opportunities. And in light of that, are considering potential sales. So people are thinking about transactions, engaging with counterparties regarding transactions, signing deals, and trying to get them done.
I love that. And I had the privilege for the past 2 days to be at the Fortune Most Powerful Women Summit, which was here in DC. And I have to say the level of M&A activity and roll-ups within certain sectors amongst female CEOs was also very popular. So we see a lot of opportunity. Marty, I'm going to come back to you. You represent a lot of companies on the sell side. What did deals look like in the beginning of 2020 through 2021 and to now? Because so much has happened since COVID and we're on a little bit of a roller coaster. So what are you seeing?
Sure. So we spent a lot of time early in 2020 when the pandemic first began, assessing signed deals. Could they get done? Might they be changed? And frankly, a lot of time was spent between parties disengaging, which is a rare event. Usually in M&A, we spend our time figuring out how best to engage. But as lawyers, we often focus on conditions to closing, contract termination rights, that sort of thing. But rarely do signed deals not close. The early pandemic was an exception. There were a concentrated number of mutual terminations and buyers wishing to terminate, asserting material adverse changes into the seller and or seeking to renegotiate price. Since then, agreements and deals do look similar to what they did before, with a few notable exceptions. Regulatory issues, principally antitrust and national security issues, are now firmly front and center in negotiations, and sellers are increasingly insisting on reps and warranties insurance so as to avoid post-closing exposure and ensure price certainty. Buyers, both PE, where there's an abundance of capital seeking to deploy, and corporates who are seeking to sustain and or increased growth, are eager to buy, and as mentioned earlier, valuations are robust. Another element here is the shareholder activists in public markets are stimulating companies to explore strategic alternatives, whether that be on the sell side or on increased buying. And I'll just emphasize again, just as professional services firms, I think we can all agree we've seen historic levels of demand for our services, and that's put a tremendous strain on the humans who do the work.
Well, we do not underestimate that, and we really appreciate you all joining us. Andy, I'm going to ask you if you can comment on the speed of deals since the pandemic started, and where are they now?
Certainly. And I think just to maybe sort of repeat something that, or build on something that Marty just said, when the pandemic sort of first hit, everything slowed down, and there was just a sort of concerted and definite decline in activity for about a month. But by the end of June, I think that it disappeared, and the pace of deals and the speed at which deals were getting done had started to accelerate. And I think what we were seeing in the market is that there was so much demand for particular deals that sellers sort of recognized they were able to get away with maybe more aggressive terms and a more aggressive process than they had maybe in the past few years. And so what I've seen is a much more formal sort of process, both for buyouts, whether it's on the private equity side, even for some corporate deals where the bidder may be the only sort of, or the acquirer may be the only sort of game in town. And then also on the growth equity side, where typically you wouldn't see as much sort of structure around the sale process for growth equity, but they were now the most attractive asset on the street, and they were able to dictate terms much more aggressively to potential acquirers. So you were seeing a very similar situation to buyouts, where a sort of relatively early stage company could almost go out and compete for growth equity with any number of players, and weren't necessarily looking for the sort of support that some of the larger, more established funds might have provided in the past, such as management support, access to their other portfolio clients. At the current stage, at the current point in time, I don't think anything's really changed, except maybe on the SPAC side. I think if you're coming to do deals, you're being told sort of how long you have. You're being given the acquisition agreement with very little opportunity to negotiate it, and the sellers are coming to you and saying you're going to use rep and warranty insurance in this specific transaction. I think on the SPAC side, I recognize there's still a few SPACs out there, but we've the volume of SPAC deals has collapsed compared to what it was, and I'd say at the end of Q4 2020 and Q1 2021. And I'm not sure. I think SPACs have had their day. I think they'll still be around, but at a much lower volume than we saw in the first 3 to 6 months of this year.
And I know we've already got questions teed up because SPACs took up a significant amount of airtime for a while. So we see the questions coming in, so I appreciate that. But both Marty and Andy, you have alluded to insurance several times. So Emily, I want to bring you into this conversation. And any advice on insurance as both startups and corporates look to get into this M&A space? Okay, we're going to ask you to unmute because I know you're giving some great advice.
Oh, and that was it. It was so great. Now it's all gone. No, it has been unprecedented in terms of demand, which has had a knock-on effect both on pricing and availability, where we were seeing rates of sort of 2.5 to 3.5 for the limit of insurance. We're now seeing 4.5 to 5.5. Luckily, retentions haven't changed. But what I will say is, and it'll be interesting to see in early next year how that maintains, because right now the issue is there's an awful lot of deals chasing a limited amount of capacity, and people have literally written what they can write, and they just don't have the bandwidth in terms of the bodies, I think, as Marty talked to before. So where before we were seeing sort of 4 or 5 quotes for every deal, we're seeing 1 or 2. And occasionally none at all. So it's definitely different. I would say if this is something you're contemplating, be aware of the price increase. Be aware that the current multiples that are happening are very disturbing to several underwriters. And while some are still underwriting without a multiples exclusion, many of them are seeking multiples exclusions or caps or are drilling down. Obviously, the multiple cap is a contentious issue as to whether it is a positive or a negative, but that may be too much insurance nerdery to go into right now. But I would say, our book, Woodruff Sawyer's book, is about 50% private equity and 50% corporate. We've just always been very strong in the public technology company sector, and they're coming to us for sort of the first time. What I would say to corporates who are looking at using this is the way you do your internal diligence, you're often looking for different things than the underwriter is looking for. So I would say talk to your broker early and often about the best way to memorialize your diligence, the best sort of templates to use, sort of experience on handling the diligence call, because all of those things are sort of new to the corporate buyer in the way that they're not to the private equity buyer. And, in terms of startups, my advice would be, the single biggest cause of claims or the biggest attack is always on the financials, which is why underwriters have got very tight on giving quotes where companies are not audited. And if you are looking at buying a smaller company and it's not audited, be aware that you're going to need a Q of E. If you are a smaller company that is looking to sell, I would say there isn't value in getting a sell side Q of E because underwriters on a buy side are looking for a buy side Q of E. But the financials and, cyber are where underwriters are focusing a lot of time. We've seen some back and forth on COVID exclusions. Some underwriters are very broad. Some have gone back to a much tighter stage, which is interesting. But cyber, the availability of cyber coverage in the target, any history, those are the areas in financials where underwriters are particularly nervous and looking very closely, irregardless of industry sector.
I appreciate that. I'm going to deviate 1 second because you brought up COVID. And so I'll start with you, Emily, and then we'll go around. I guess, what has been the impact of COVID as you're looking at these deals? What are some of the things you're seeing in terms as it relates to price, as it relates to insurance, where there might have been significant shifts and cycles in their financials, and now the buyer's kind of looking in what's the projection. So I'm just curious, you brought it up and I don't want to lose it because I'm not clear we're done with it yet. So I'm just curious, what is the impact you've seen, Emily, and then we'll go to you, Andy.
Sure. I think what we've seen was initially underwriters put very broad exclusions. Then they realized that COVID was not quite the life-ending situation that they thought. Some got very broad, and some got very, very tight and had a competitive advantage as a result. And some of those that got very tight are now getting broader again. I think from an insurance perspective, what it means is a couple of things. They're looking at supply chain, and they're looking at customer contracts, because those are the sort of the two things that are going to be disrupted the most by COVID. There's much less concern about sort of protocols internally, especially with so many companies working remotely quite quickly. The other thing that's become interesting, I think, is on the projections for both those companies that have done well in COVID and those companies that have done poorly. Because where historically someone would come in and they'd look at last year's balance sheet or the years before, that's no longer a typical balance sheet in either direction because of COVID. So I think in terms, and Andy will have much more intelligent things to say on this, but in terms of when you're looking at valuation, obviously those who have done well want you to look only at what their company has done since COVID, and those who've done badly want you to take a much wider stance in the financials that you're looking at. So I think that's where it's impacted insurance most. And then, of course, with the proliferation of people working from home, again, that brings up a lot of the sort of cyber concerns and how a company's handling that.
Absolutely. Thank you. And Andy, it's all about perspective. So what's your perspective on COVID and the impact in the space?
Yeah, COVID was, at the start of COVID, every sin was blamed on COVID. And, a year later, I think every sin is still being blamed on COVID. But COVID's over, particularly for technology companies. Some have done better than others, but if you haven't, I would find it, I'm skeptical of somebody still blaming COVID on weak performance or underperformance in any aspect of the technology sector at this stage. I think there is still some, if you're looking back for trend, particularly around balance sheets, if you're setting net working capital, for instance, or thinking about what may be required, there's still some elements of the historical period that may come in, but it's the impact is much less these days. In terms of valuation, the one thing and the main area where I'm seeing some difference in how companies are approaching it in the market is how people are thinking about some of the expenses associated with, or personnel and travel and entertainment expenses associated with COVID. The amount they're spending is still at a much reduced level. I've seen some companies say this is a new permanent level, but then others are saying it's coming back in the next year or two. I don't think it's coming back in the next 6 months, but definitely within a year. I personally can't see how the technology sector stays sitting at home and isn't on the road spending money. I know there's lots of press about people not going back to the offices, and the tech companies that seem to be at the forefront of pushing that data out further. But again, at some point, I think the American worker needs to socialize. They need to be back in the office, and I think from early next year you'll start to see sort of real estate and other costs go up. And if I look at some of the analysis I'm seeing, I'm not seeing quite. I'm seeing fairly aggressive assumptions about reduced costs and this new permanent level of profitability, which I think if you're doing diligence, you should be somewhat skeptical about.
I appreciate that. Thank you. And so, Marty, I'm going to come back to you, and I'm going to shift the conversation and just say that in this new environment, what kind of M&A deal terms are you seeing right now, and how have they changed?
Sure. Let me focus on a few in particular. On the private company side, sellers, typically with strong pressure from their investors, are demanding tough and seller favorable terms. That goes to certainty of price and certainty of closing. On price, sellers are demanding no post-closing exposure. We talked about that with the reps and warranties insurance, and now there's a bit of a friction there given the demand and the supply. On certainty of closing, the issue becomes minimizing regulatory risk for the most part. This administration has appointed individuals to positions of authority with a strong eye towards stricter enforcement of competition laws. Acquisitions of competitors, potential competitors, firms in vertical relationships likely will face longer and more arduous reviews. U.S. national security reviews are now more frequent and accompanied by similar foreign reviews. So all of that combines to make more time between signing and closing, That has impact on the seller's business, managing customers, employee relationships. There's a tremendous strain on the enterprise. And the risk of not closing is often monumental, because remedies, even reverse breakup fees for failed regulatory conditions, simply may be inadequate. So what we're advising when we represent sellers is to ensure that the acquisition agreement protects those interests on the regulatory front. And they're really two. On the deal certainty issue, realize that an attractive premium is only an attractive premium if the deal closes, right? So we have to be cognizant and look into in some detail as we're negotiating the agreement what the likely review risk profile is, including the timing. These reviews, challenging situations can take a year or more to close. So it's not just a few months on the more challenging ones. And so you've got to plan for a prolonged review.
So it sounds like patience is turning out to be key. Recognizing that there are folks here in the US and beyond, I would love to be able to come back to you, Andy, and talk about what you're seeing with respect to international M&A transactions, more or less than last year, and any trends that we should be thinking about, since many of the companies that are probably here have presence across the globe.
Certainly. I think it's... where are we? We're 18 months into COVID, and I think COVID, you almost have to look to the pre-COVID period to get a good comparison. I think pre-COVID there was much more international M&A, both sort of into and from the US. There has been some since you could say the sort of rebound in M&A activity. I'm sure it's much more active across many areas, but for the clients I'm seeing and some of the sort of technology subsectors, I'd say it's still at a depressed level. I think the other trend that is interesting is I was seeing a lot more US-Chinese activity sort of pre-COVID, particularly from sort of US companies looking at potential Chinese acquisitions. To me, that's almost completely stopped. There's still some elements around the edges, and I think that it'll start to grow. But to Marty's point about regulatory sort of concerns, there's just a much greater sort of sense of awareness, and that even I think it started under the Trump administration and it's continued into the Biden administration. The one I'd say on the positive note, I've seen a recent uptick in more international M&A. Where I'm seeing activity is quite a bit going back into Europe, where there's I think US buyers are becoming more comfortable around the stability of and the response to COVID and the reemergence of those economies. And then in some of the emerging markets, I've seen a lot more in Africa, for instance. I hadn't seen much activity there for a while, but I'm beginning to see more interest. And then a little bit in Australia, I'm beginning to see some more focus in the sort of Australia and New Zealand areas.
I appreciate that. And let me ask you the next question, but we did have a comment in the Q&A. I want to make sure that people are tracking this conversation. They said, could you please define multiple cap QMB? And you're still on mute, but I know you got some great answers.
So multiple cap, and I'm sorry, is sort of insurance nerdery. When a company is valued on a multiple and you insure that deal, there is a possibility that in the event of a loss, you are going to claim for a multiple loss. So someone paid 10 times. If it's a direct loss, like there weren't the right amount of chairs in the boardroom, then you're only going to get claim for those chairs. But if it is something that is fundamental to the value of the company, you may say, I paid 10 times, so I should get 10 times that loss. And because multiples are so incredibly high right now, what some underwriters are doing is saying, okay, we won't exclude multiples, but we will cap. So you have paid a 25 multiple, but in the event of a claim, we would only pay 10 times multiple if you are able to prove that loss. Now, the reason it's sort of debatable is that some lawyers, and again, Marty probably has an opinion on this, some lawyers feel the fact that they've even brought up the word multiple means that they have sort of forced their hand and admitted that they're contemplating covering a multiple, whereas the traditional policy has had silence for silence. So they don't say anything about multiples one way or the other, and we leave it to claim time to sort of kick the can down the road and decide about multiples. Because they're capping it, they are basically saying we are understanding that we may have to cover multiples. So there's some debate that while the cap is problematic in that it limits the amount of claim that can be made, it's also potentially positive in that it has laid the groundwork for such a claim. In terms of the other one, QOE, and that's my accent and I apologize, is just quality of earnings. So just something, a different form of review that buyers can undertake on unaudited financials that is sort of a standard of diligence that underwriters are looking for.
I appreciate it. Before I ask that, Marty, did you want to weigh in anything there from a legal perspective in terms of definitions?
No, I think you, Emily, articulated it well.
Awesome.
Thank
Great.
you.
So, well, thank you, Emily and Todd. Thank you for your question. And we will have questions when we are over. But Emily, for you, from an insurance lens, how are providers measuring risk and what's your advice to help mitigate those risks?
Sure. So there's two ways to think about this. Right now, in terms of if I have a submission that I'm taking out to the market, it's purely economic from an underwriter's perspective. They have X number of people that they can write a deal in. And deals take a certain amount of time, whether they're complicated or they're simple, whether they're corporate buyers or private equity. And they are basically picking and choosing what they think are the most financially viable deals for them. In other words, the most premium for the least amount of time and diligence work. So right now, the sort of mid-sized deals are popular. Those that are very tidy and vanilla are very popular. And we're having to push harder on deals that are very small, or deals that have some kind of hair on them. Because from an underwriter's perspective, why would I spend my time on this deal that's going to be a lot of work and is going to give me X dollars of premium, where I can spend my time on this deal? And always with rep and warranty insurance and always with M&A, the risk to the underwriter is that the deal won't complete. So, and then they'll have done all this work and they'll basically get nothing for it. So they're also looking for certainty in the same way that everybody else is looking for certainty that a deal's going to go down. In terms of, and that's just the sort of supply and demand of it. In terms of how they're assessing risk, it's, it is essentially rep and warranty insurance, and the process of putting it in place is doing diligence on the diligence of the buyer. So what they're looking at is how hard has the buyer kicked the tires? Who did they have kick the tires? Was it someone like Marty and Andy, or was it someone from a small regional firm? Are there nice big diligence reports, or are there bullet points on a slide? And the more confident they can get that they are only going to be on the hook for that which is truly fortuitous or fraud or a genuine mistake, that is what they want to get to. They want to write the risk once they've already decided that they want to write the risk, but how they're going to assess it is the quality of the diligence done by the buyer. So I would say, in order to get the best coverage, the best diligence is going to be the one that wins out and gets the broadest coverage. And also an awesome broker who will get rid of all the exclusions at the end.
Marty, you want to weigh in on that one? I can see it.
Definitely awesome brokers to eliminate exclusions, but it's the exclusions where, as lawyers, we really get into it, because a deal at a business level may be cut as a reps and warranties deal where the sellers are expecting not to have any post-closing exposure. And when there are exclusions in the insurance policy, the issue comes up, who bears the risk of that which is excluded? And so oftentimes when that happens, there's a there's a subsequent negotiation before a deal signed about the allocation of those risks. And, we can get into more detail about that later, but that's a little hole in all of this.
Sure. Andy, you want to weigh in on that one too?
Yeah, I think the one thing I think, and Emily sort of alluded to it, is just I'd say the level of sophistication among the insurers around performing diligence on the diligence that's been done by the buyer. It's definitely they've become much more sophisticated over the last sort of 12, 24 months, and they're holding buyers to a much greater standard and almost in a way dictating the level of diligence they want performed or they think should be performed, which every buyer's got their own preference, but they're now they can in some sort of situations and instances have another level of diligence imposed on them by the insurers, and buyers have to sort of think about, even if they don't want an accounting firm or a law firm or an IT firm coming in and doing diligence because they don't think they need it. They may not need it themselves to make the decision, but they may need it to get the insurance. And so we're starting to see situations where we'll be asked to do sort of very specific work, not for the buy or sell decision by our client, but really just as part of the package to get insurance.
That's very helpful. I just want to remind folks, we have a couple more questions and then we're going to open it up to the group. So please put your questions in the chat. Please use the chat function that's at the bottom of your screen. Marty, I want to come back to you. Can you speak to the velocity and volume of deals getting done? You all have done an amazing job of surfacing what some of the inputs are, but how many are actually getting across the line and what does that look like?
Yeah, I think we saw some of the statistics earlier. Lots of deals are getting done. And I would say lots of deals are getting done much more quickly than they used to get done. Corporates are willing to act quickly. Yes, doing diligence, but acting quickly. And once they decide to do something, they want to get their deals done. People are saying no more quickly. So there's less window shopping, I would say. People are either deciding to get something done or not get something done. On the PE side, deals are getting done even more quickly. Again, in times past, PEs, build their models, they do lots of diligence, et cetera. But certainly in buying public companies, PE firms are asserting and in fact executing that, very quickly. Go ahead.
I was going to say, and define how quickly, because we've heard different timeframes from each of you based on your roles. So just think of a couple of deals. What's the average time?
From the time there's a handshake on price in a public company situation, a public situation, deals are getting done in a 2, 3, 4 week time frame.
Wow. Okay. Thank you.
That's just 2 or 3 weeks is fast.
Yeah.
So that everyone in the audience understands, an M&A deal, a process from a seller gets an interest from a buyer. Overall, that may take 2, 3, 4 months from initial approach to signing up a deal. A SPAC will take, several months longer than that to get to a signed situation, and an IPO even longer in terms of the preparedness and everything that goes into it. So just to stack all of those up, M&A deals can get done on a relative basis much more quickly.
Thank you. And hopefully that'll make some more people a little bit optimistic. I want to put this question to all of you. Have you seen corporates increase M&A activity in general over the past quarter? And if so, thoughts on those causes? And I know some of you have already alluded to this, but would love to just dig a little bit deeper for the audience on kind of corporate activity and how that's changed or how that's picking up. And Andy, we'll start with you.
Got it. I definitely have seen corporate activity pick up in the last quarter for my clients. I think they were astonished by the sort of, you could almost say, the madness of the markets and the madness of the valuations. But corporates have to keep operating. They can't sit there for forever. And I think they've reached a sort of. They've reached a point psychologically where they believe this is the new norm, and they have to start acting. They have to grow their business, and they have to change. They have to acquire new products or enter new areas. And so even if the multiples are higher than they'd like, they don't really have an option. They've got to. They can only sit out for a year or two, and that year and a half has passed. I think there's a lot of nervousness around the antitrust aspects. But if you're a mid-market, smaller tech company, by that I'd say, in a way less than $10 billion, unless it's a niche area, maybe around some semiconductor product or some specific technology, that antitrust issue probably isn't so critical to you. For some of the bigger players, I think Facebook, Google, Amazon, Apple, they're doing sort of numerous deals a year. I think they're going to keep trying to do that volume of deals, but I think there's a greater risk that they're going to be permitted, and I think there's potentially a pullback from very large acquirers, but I'd say, as I said, middle market tech. I think those players are going to come back very strongly.
Sure. All that cash they had on hand, they're putting to use to try to maintain that competitive advantage. So it makes complete sense. Andy, Marty, what about you?
I would agree with what's been said. We're seeing corporates being very active now, competing with PE funds. It used to be PE funds would buy different types of companies than the corporates, but the PE funds are buying high growth companies and paying big multiples, and the corporates are looking at those companies for growth as well. One of the issues that the corporates have is if they're growing at a certain rate and the target company, as strategic as it is growing at a different rate, then the investor reaction to the combination might be well looked upon or frowned upon, depending on what people believe about both the strategic rationale and the financial impact in the near, medium, and long term.
Got it. Emily, what are your thoughts on this? What are we seeing in the last quarter? What are the corporates, and what do you think the causes are?
Sure. So yes, obviously we've also seen an uptick. Partly there are certain corporates that have done particularly well over COVID and have money. There's always been a lot of dry powder, but I think for some there's even more dry powder than normal. And there are certain sectors that have become incredibly attractive, like telemedicine and data centers, that people are going to try and take advantage of that and get those sort of as part of their company. What I can say is that I think what shows for me, and obviously this is my experience, is 18 months ago, many corporates were adamantly opposed to rep and warranty insurance. Now that it is table stakes, if you want to compete, they're sort of coming on board with it. So I see that they are willing to go to lengths that they weren't willing to go to before. And they're willing to move at speeds they weren't willing to move to before. I think they always have a slightly different ROI in mind than a private equity firm when they're looking at an acquisition, and they're much more concerned about integration perhaps. But we are definitely seeing our big tech companies scooping up as much as they can that they think is sort of the new wave, or those that have done badly that they think they can get a good deal on.
That's very helpful. So I love it because I see the questions coming in, and I know that you guys, you ladies and gentlemen, are more than ready to be able to answer those. But before we just dive into the questions, because it looks like they're going to take us in a couple of different places, I'd love for each of you just to give kind of a key takeaway that folks in the audience should have, because we've covered COVID impact, we've covered buyer side, seller side, valuation, all kinds of stuff. And so we're going to start with you, Marty, because you are going left to right in my screen. What's one key takeaway? And then we'll go to you, Andy, and then we'll go to Emily, and then keep the questions coming. And we want to get the audience engaged.
I think when executives get approached as sellers, when buyers approach as buyers, there tends to be a deal intoxication that takes place, and people get very attracted to the process and completing the process. And I would remind everyone, at the end of the day, a closing of the deal is just the commencement of the relationship, not the end of the relationship, right? You end up combining those companies. People go to work every day. People have to perform together, who didn't used to have to perform together, and are held to account by investors. So keep the eye on the North Star of that going through the process, as intoxicating as it might be.
Sounds like a marriage there, Marty. People think the wedding is the end and it's really just the beginning. So that's personal and professional. I love it. Andy, what's your key takeaway?
Yeah, I think if American consumers have money in their pocket, then they'll spend it, and if they spend it, the stock market goes up. And I think the population has still got a lot of money in its pocket, and I think if the stimulus and the infrastructure bills are passed, there's going to be even more. We can debate how much inflation or how inflationary it is or not, but notwithstanding that, with this again wave of cash coming in, I think it's going to keep the stock market sort of rising, and with that sort of valuations and with the rising stock market, because M&A is a confidence-driven activity. If the stock market's rising, then you'll get more M&A. I think the other thing I would caution, I mentioned it when I was on the panel, maybe I think it was about 6 months ago. We've seen a few cases of fraud, and you always get cases of fraud. If there is any sort of volatility in the market and you start seeing particularly SaaS company growth rates slow down, I wonder if you're going to start seeing an increase in the level of maybe less than truthfulness from some companies as they start to raise capital. And I just think we're entering in a time where if you're looking to buy, then you should be in some cases fairly skeptical about some of the existing revenue streams and what the projected revenue streams are.
Got it. And Emily, I'm sure skeptical is going to be in there somewhere as the insurance person. So what is your key takeaway?
I'm a broker, not an underwriter, so I'm just totally optimistic about everything.
I love it.
I would say, from a purely practical perspective, there is, for the remainder of the year, a tremendous pressure on professionals in the service sector. So if you are thinking about it, you're looking at it, be very aware that it's going to take you longer maybe to get a QOV. It's going to take you longer to get the lawyer that you want, and that they are tremendously under pressure for diligence as well. And that's, always a slightly scary place. When people are overstretched in the diligence process, that's where accidents happen. As service providers, we never want to say no, and we never want to not do the best. But sometimes that which is achievable is not the same as that which we wish was achievable. So be aware that your service providers are tired.
Got it. I think a lot of people are tired. So yes, thank you. So I'm excited to open up questions. Keep them coming. Let me give the caveat though, we don't have all day. We do have a limited amount of time, but I'm going to do my best to get to as many questions as possible. So I'm going to pull one from Ralph, who has a question that says, I'm interested in founder triggered liquidity events. How is the market approaching leverage buyouts led by founders? And I'll let you all decide who's going to take that one. And obviously we also welcome different perspectives. Who wants to start? Marty?
Sure.
I saw you thinking about it.
Yeah, and my data set is only my data set, but the deals that I've been involved with in the last year or two in technology, and those that I'm familiar with, that where private equity has done the buyout, the founders are not leading that process. Independent board members, committees of independent board members typically lead the sale process on behalf of the target company. So we're just not seeing founders step up and say, I want to join with a group of investors and take the public out of the stock. It's usually a decision, is the value that we are being offered by private equity or corporate through a diligent process to understand what the value of our company is, what someone's willing to pay, is the buyout price, number one, adequate to compensate us, the stockholders, for the value of the standalone plan? Okay, is it adequate? And is it the best price reasonably attainable? Okay, and whether the founder is leading a group or prefers one group over the other is really not relevant to that board decision-making process.
I appreciate that. Andrew, Emily, would you weigh in on that or anything else to add to that?
Yeah, no, I'd agree. We're not seeing sort of, as Marty said, we're seeing not the sort of the individual founder driving the deal, and that the insurance market prefers it that way, that it is not sort of a, it's not being driven by a particular culture or a particular individual, but that it is being a decision that is made by several people in a sort of very serious and thoughtful manner.
Got it. Thank you. So we do have another question from Don. Sometimes companies enter into strategic partnerships with startups. So companies just starting out with patented technology or a proven concept. And I think, Andy, you alluded to some of the M&A that's happening in Silicon Valley. What, if any, trickle-down consequences does the vibrant M&A environment have for early stage startups and multinationals? And Andy, I'm going to start with you on that one.
Got it. I think every large corporate in Silicon Valley now has a venture fund, and this is now the sort of almost path to partnership with these startup businesses, where they may not have preemptive rights around the sort of technology or around purchasing the company for due to accounting purposes or accounting reasons, but it allows them to support companies where they think the technology is interesting, and they may get some insight as to how the market's evolving. In a way, it's not. It's much more common in biotech, where sort of development stage companies will have partnerships with some of the major farmers. I don't see that. You can see elements of it coming into the technology space, but I don't think it'll ever be as structured or where the relationships are as strong on the technology side. But I think you struggle to find a large technology company that doesn't have a venture fund and that isn't trying to make investments and doesn't have a team of some of its strategy or operational senior operational folk going out and looking at startups and looking at how they can partner with them.
Sure. Marty and Emily, I saw you both nodding your head. Anything you want to add to that?
Yeah, I would observe, as Andy did, that in the life sciences area, the investment, the strategic partnership often is a pipeline to M&A, or certainly is more so than in the tech space.
Emily, anything you want to add there?
Absolutely, it's a biotech phenomenon, and when we see it is when it's successful and they've now got to the stage where they want to sort of buy out or acquire. We don't get involved in the early part, so I have far less to add than Andy and Marty on this topic.
Well, I will say this, as soon as you spoke, Don, who asked the question, was quick to say, and we are a bioscience company. So you all made someone happy. So never underestimate your words there. I'm going to start with you on this one, Emily. It's from Rahul, and I hope I'm saying his name right. Do you think the increase in acquisitions by corporates and PE funds has also led to an increased amenability while negotiating reps and warranties?
It's an interesting question. I think, let me make sure I'm getting the question right. Are we seeing that because there's more M&A, we're getting better kind of reps and warranties? Is that can you repeat the question?
Oh, that's pretty much it. I'm going to assume that was all. It just said, due to increased activity, is there an amenability? So I'm going to assume he's looking for some flexibility. But Rahul, please put something back in the chat if we are off track. But let's start with that answer, Emily, and then Marty, if he changes or has a different perspective, we'll go to you.
Sure. I don't know if it is the prevalence of M&A that's making things amenable. I will say, and obviously I would say this, but it is the prevalence of rep and warranty insurance that is leading to sort of amenable terms, frankly, because if you are not debating endlessly every word of the indemnification section, And if you don't feel that your entire life is on the line for every rep, then you are much more willing to give a fulsome set of reps. However, there's a ceiling because underwriters were not born yesterday. And so you still have to give reps that are sane, and the buyer still has to prove that they've diligenced them. So I think while rep and warranty has allowed for a easier process, a less contentious process, there is a point at which, if you're promising the earth, that's great, but the underwriter is not going to follow you, and then your buyer is going to be looking for another form of recourse.
Gotcha. Marty, you want to weigh in on that one?
I agree completely.
Oh,
Yeah,
okay.
it reduces transaction costs, right? Both literal and figurative transaction costs, because people can agree on a set of reps and someone else is paying the price.
Yeah. Andy, did you want to add to that?
I couldn't add anything that
Okay.
anything better than Emily and Marty.
I love it. I love it. So we have someone who's anonymous. I don't know if this is good or bad, but Don said, thank you for the answer to your question. He hopes to need you all in about 18 months. So let's hope so. And he clearly needs to plan early, since you've all said there's a human capital shortage. From anonymous, any advice for an early stage company, which is fundraising, but there's also a negotiation for an M&A. And we're going to have a series of questions that may take us back a bit as those on the seller and the buyer side even start this process. But anyone want to weigh in on that one? How to manage that fundraising and M&A discussion?
That sounds like one for you.
Yeah, probably Marty. I can give a couple of comments.
Please go ahead, Andy. Please.
I think that the process isn't too dissimilar. I think it just comes down to money at the end of the day. If you get offered a bucket of money and it's such a big bucket, then you'll sell out of it. If you think you'll get offered 2 big buckets of money in 6 months or 12 months, if you need a little bit of funding, then you go the other route. There's clearly differences in the agreements, but from an accounting perspective, they're not. The actual process is so dissimilar.
Yeah, I think it's a difference in what's the mission, what's the vision of the company, right? I mean, sometimes companies with big missions and big visions and lots of capital behind them just get offered prices they simply can't refuse. And it would be a breach of duty not to sell. But we see companies oftentimes on a trajectory where they want to stay independent and they want to raise capital and they want to go try to build and grab the brass ring. And so it's an apples and oranges comparison, really.
Gotcha. So let me take a step back, because we have a couple of folks that I think are looking at this market and somewhat getting excited about what you're talking about. And it sounds like people have been poking around with some of these companies. So let's just start back to the basics. Is there a checklist for conducting an M&A? And I'd love for one of you to take the buyer side, one of you to take the seller side, and somebody else just take in between of kind of best practice. But we're getting a lot of interest in the chat to kind of get into this space. So Marty, I see you. Let's start with you. So once we do Marty, let's do Emily, and then we'll do Andy. And we'd love to hear all of you from your perspectives. What's a good checklist to get this thing started?
The way I would think of it, I'll take the seller for a moment. The way I would think of it, and let's say for a moment I'm the CEO. I really have 3 constituencies internally that I need to understand and make sure that there's an alignment among each of those 3 groups and between those 3 groups. I have my shareholders, the board, and management. And I need to know my investor sentiment and where the votes are, what the expectations are. The board is composed of individuals. I need to know how they think about life and the life of the company and the transaction. And I've got the management team. And whether the team can deliver in one way, shape, or form, either on the standalone plan or in an integration with a third party or what have you. And so as an advisor to that CEO, I think a lot about how do I understand and the sentiment of those 3 constituencies, and how do I manage those 3 groups so that there is alignment at the end of the day. Deal doesn't work without that kind of alignment. That's what I call the internal triangle. Then there's the external triangle. That is to say, the alignment with the counterparty. Is there business logic in the deal? If there's no business logic, it doesn't make sense. Is there alignment on price and terms, or expectations ultimately on price and terms? And ultimately, do the teams work? Does the chemistry make sense? Without those three things in alignment, a deal doesn't happen. So I think of that scattergram of issues, and I try to build alignment internally, build alignment externally, and how you choreograph all that. That's a bespoke process for any particular set of characters.
Got it. Emily, anything you want to add to that?
Sure, and it's not dissimilar to what Marty is saying, that we're going through that process is a sort of evolving discovery as you meet different potential buyers, and as you're trying to decide, as he said, vision and final outcome and what's important to you. And also just from a practical perspective, if you are looking to be acquired, I would dot my I's and cross my T's. There's no, you're going to be looked at through a lens that you find disturbing in terms of what you're required to produce and show and have evidence of, regardless of warranty insurance. Buyers look very, very closely. And so anything that's sort of missing or hasn't been done or hasn't been tidied up is going to become a problem during the process. So I'd say before you even start down that road, I'd get very clear about, all of your ducks are in a row, everything is sort of provable, that there aren't sort of missing random stock shares and certificates and really boring things like permits and assignments in your employment contracts, all that sort of stuff, which is going to sort of trip you up once you get further down the process.
I would say companies are bought, not sold.
That's a great way to look at it. Great way. So Andy, I'm going to take you in a different direction because I'm mindful we only have a few minutes left and I want to make sure that the audience feels like we answered their questions. So I'm going to start with you and then anybody again can weigh in. I'm going to bundle a couple of questions that are really around the role of strategic buyers and investors in this M&A process. So we have someone that says, how can one find and kind of discuss a strategic buyer? And then any advice for startups on managing relationships with strategic investors who could be strategic buyers. So anything you want to kick us off there with, Andy?
I think that what they're, it's always difficult to find the right partner in a company and in life. I think the easiest way here is to get good advisors, and I think the good advisors you need are if you're looking for a capital raise or you're looking for access to strategics, then you typically have to go through an investment bank, and then it's just selecting the bank where you like the bankers. I think that's always important. You have a good relationship with your advisors on a personal level, and they've got the experience. Saying that, I think the most important advisors that anyone can have in M&A are the attorneys. I think that's the most critical. I know that's what I'd like to say that they're accountants, but it's not. It's definitely the attorneys. And even to the last question, what's important in trying to buy or sell? I would get I'd get the Wilson Sonsini guys involved before pretty much anyone else to get their perspective on how realistic and achievable any sort of buy or sell transaction is, and what I need to do to get organized to consummate it.
Well, you made Marty's day with that. So I'm gonna Emily, is there anything
I don't
you
have
would
any. I have nothing.
call a lawyer. Call Wilson Sonsini. Emily, what would you add to that?
I'm exactly what Andy said, but also, it's very easy, as Marty referenced earlier, to become intoxicated. There's a lot of money and a lot of big numbers floating around, and you don't necessarily want to marry the first frog that you kiss.
Love it. Well, so we are winding down in terms of time. And so I want to just thank everybody who posted their questions. And I apologize right now, we did not get through them all. So I take full responsibility for that. I just want to, in the 2 minutes we have left, just see if there's any parting words that each of you have for folks out here. Clearly, folks are engaged. There were lots of questions. I apologize. We didn't get to all the SPAC questions, but any kind of top line that you would want to share, anything you didn't get to talk about that is a good way for us to end. And Marty, I'm going to start with you.
Great. When I think about advising on transactions, M&A is different than a lot of other law. It focuses on ultimately agreement, not disagreement. Okay. And so driving consensus among all of the constituent parties internally and externally, it's all about saying yes and saying, yes, this is something we can live with and something we want to do. Rarely do these deals happen out of, lack of desire. So the whole process is one that is best affected, in my judgment, through understanding that we're driving forward. Yes, there's tension, there's negotiation, but it's not combative. It's how do we say yes? How do we reach agreement?
I love that. Andy, what about you?
It's M&A is exciting and it's fast paced and people can get heated about it. So I think you've always got to try and remove yourself from the hubbub of what's going on and be patient and sort of thoughtful about what you're doing, even if the other side or your advisors are or your own internal employees are maybe a bit too excitable, because as soon as you start losing perspective and you're not thinking and you're not able to detach yourself from sort of personalities, then you start to get into problems on M&A.
Right. You should not approach as if you've just won the Powerball. Is what I'm hearing. Emily, what about you?
I agree with Marty. It's one of the very few areas where both parties can win. And the best practitioners are always those that are trying to find a solution rather than making demands and banging their spoon on the table. And I think the same is true for insurance. We're not, it can be a difficult process, but no one's trying to trip you up. We're all trying to get to the same place.
I love it. I love it. Well, everybody in the chat is saying they love this. My 3 takeaways, I'm going to call it the 3 Ds from you all. One is that there's some deals out there and that people are being decisive, but the angel is in the details. And so while the transaction speed is getting there, there's still a lot of work that folks have to do. So I want to thank each of you so much, Marty, Andy, and Emily. I want to thank all of you for joining us. Colin, thank you for the privilege and pleasure. I know I learned a lot and I hope everybody else in the audience did. So back to you, Colin.
Thank you so much, Melissa, Andy, Marty, Emily. I learned a ton, and hopefully you all did too. We are at the 10:30 mark, which means that we're about to take a quick break so you guys can get refills on coffees before we jump into our next panel. Before then, I'm going to launch a quick poll just in case you have any follow-up questions for any of our panelists. So let us know if you'd like a meeting or just to answer any questions you may have that we didn't get to. But our next panel at the 10:40 Pacific mark is M&A strategy for early to mid-stage entrepreneurs. So we're going to take a quick break, let you refill coffee, tea, take a stretch, and we'll see you back then. So we are looking forward to welcoming you back at 10:40 a.m. Pacific. See you then. Welcome back. Welcome back, everyone. And for those of you just joining us, just a quick reminder, we're going to open it up for live Q&A at the end of this panel. So please submit your questions in the Q&A function at the bottom of your screen throughout the discussion. As you settle in, we want to get a better idea of who we have joining us for the session and what you're looking to learn. So I'm going to launch a quick poll for those of you in the audience. So in the next 3 months, how many of you are planning on entering M&A discussions? So let us know. Looks like we've got some people who are all in. We've got some people who are not quite yet. So it's great to learn this, which will help our panelists understand what we're gonna get into today. So I'm going to end this poll and share those results. Looks like we got a pretty good mix. So hopefully our discussion today will help all of you understand the early to mid stage strategies for M&A for entrepreneurs. So without any further delay, please join me in giving a warm welcome in the chat to our special guests. Our moderator for this discussion is Liz. She's the CEO at the Pill Hub. We've got Chris, who's the strategy managing director at KPMG. We've got Rich, who's a partner at mergers and acquisitions at Wilson Sonsini, and Luke, who's the vice president, private equity and transactional risk group at Woodruff Sawyer. Welcome, team. So happy to have you guys. Liz, over to you.
Well, thanks for having us today. I'm excited to be here today to moderate this panel. I always like to see what people wear to these things, right? Because, if we're in person. Luke, thank you for putting on your best waist up. Thank you. Well, just to introduce myself really quickly, I am the CEO of the Pill Club. We are a digital women's health tech company. And I joined the company late last year. My background spans a little bit of everything. I started my career in investment banking and venture capital investing. I spent a good chunk of my time in operating roles. I put that in quotes because when you're on the buy or sell side, you're like, what does that mean to run a company? Well, I got a chance to see that in a lot of different stages. So I spent time at a couple healthcare tech companies. And most recently, before I took the job at the Pill Club, I was at 2 different consumer marketplace companies, most recently at Uber. So I helped build Uber Eats from the ground up. If you've ever had McDonald's or Starbucks to you, I guess you have me to hate for that. But fun fact, I got to travel the world when I was, 6, 7, 8 months pregnant and have a lot of McDonald's in all parts of the world. I have to say the most strange McDonald's I had was Squid Ink hamburger bun on a Big Mac. It was a special promotion at the time that we then also delivered via Uber Eats. So enough about me. I'm going to turn it over to Chris just for a quick intro, and then we'll go Chris, Rich, and Luke, if that's okay.
Great.
Well, hello, everyone. My name is Chris Landman. I'm a managing director at KPMG. I work in our strategy and M&A practice, focusing in on the tech sector. Just quick background on me, I spent about 18 years working directly in industry, Intel, Apple, and operations type roles, and then spent about 8-9 years working at different startups, small companies. I was part of a startup that was actually bought by a private equity. So I've been, on your side and getting ready and preparing for diligence and what that looks like, and can tell some stories around that. And now what I do for a living is part of my job is working for private equity as well as corporations, helping them perform due diligence on targets. So great to be here.
Hey everybody, Rich Mullen, partner in the M&A group at Wilson Sonsini. We're a firm that's kind of focused on technology and life sciences companies, and a lot of what we do is representing early stage companies like you guys that are out there running companies, operating companies, as Liz said. And I've been with Wilson for about 5 or 6 years now. Before that, I was in New York at a big M&A shop there, doing a lot of private equity work and things like that. So super excited to be here today, talk to you all.
Hi, everybody. Luke Parsons here. I work with Woodruff Sawyer, which is one of the largest privately owned insurance brokerage and consulting firms in the United States. Just broadly speaking, as a firm, we've got roughly 600 employees across 18 offices and we're widely known as the market leader in placement of management liability or D&O insurance for pre-IPO companies as they transition from privately held companies to publicly traded entities. Since 2010, we've worked on approximately 35% of all of the IPOs nationwide. And with the current SPAC and de-SPAC market frenzy, it's been a busy year, to say the least. My role specifically, I lead our private equity practice group. And my role is we work alongside our more than 375 private equity and venture capital clients as they navigate middle market transactions across the spectrum of insurance. That includes anything from buy-side insurance due diligence services, reps and warranties insurance, kind of the whole, runs the whole gamut on a standard middle market transaction. And any given year, we work on about 150 to 200 transactions. So like Chris, I'm typically more on the buy side, but very excited to have this conversation today. On the personal side, I've got a set of twin boys that are 2.5 and an 8-month-old. So between the SPAC and de-SPAC frenzy and our deals we're working on, plus the children, I don't really get much sleep. So very happy to be here.
Luke, all you need is a fourth child.
Exactly.
And,
my wife's
make it
pushing
happen.
for it. I'm trying to hold off at least a couple years.
Yeah, I have 2 kids myself, actually. We're really pumped for Halloween this year. Got gigantic spiders on the outside of the house and everything.
Oh yeah,
Should
same here.
come by Liz and check it out.
Yep.
Well, so today, as much as I personally would love to keep talking about kids and Halloween, I've got 3 kids myself. I think on the docket, we are going to go through a little bit more on how we think about M&A, what the environment is like, how you get ready for it. I had the good fortune of talking to the panelists ahead of time, and I know they have a ton of experience in thinking through not just the big picture, but a little bit of the nitty gritty, how to think ahead a couple steps and make sure you're prepared. I think it's probably too cute to say that, like, it's not just when you decide you want to get bought, it just happens. There's a lot of things that you should do to create that option value for yourself. I'll say when I was at Uber Eats, I helped sell our India business. I also helped buy Corner Shop. And having been both on the sell side and the buy side at Uber Eats, there's just a lot that you have to do, and getting the right set of advisors and the right kind of steps in place is absolutely critical to pulling off a smoother transaction. So I'm excited to dig into it in a little bit more detail today. Maybe just to open up, I wanted to ask the group, just set the context. Like 2021, pandemic aside, has been a little bit of a crazy environment. I feel like in my world, every day I hear about another company that raises like couple $100 million bucks, and they're valued at like a couple $100 billion. You know, it's like one of those crazy things that people are going public, they're de-SPACing. So can you just kind of set the stage for what has been the sell side environment this year? Just like, what have you seen?
Yeah, I can kick it off, Liz. I think we're continuing to see a lot of growth, a lot of activity, especially within tech and healthcare life sciences. I think those are areas that are really going really strong. We really don't really see it slowing down in 2022 as well. We think it's going to continue. I would say from a SPAC standpoint, we went into 2021 seeing a lot of activity. It has slowed, I think, in the last few months. We've seen it kind of die off a little bit, and it's not dead, but it has slowed. And I know we'll talk a little bit more about that in our panel down the road. But yeah, I mean, sell side activity is picking up. I think that we're also seeing with potential tax legislation coming out that could have a roughly 20% impact on the transaction value. We're also seeing companies looking to, get out there from an IPO or sell side standpoint as well. So we're seeing that as well. And I'd say the last thing is really, there's a fair amount of dry powder out there with PE as well as strong, corporate balance sheets as well. So we still think it's going to be strong walking into 2022.
Yeah, I was thinking kind of the similar thing, Chris. There's so many companies out there, strategic buyers and private equity funds and VC funds and everybody in the system that has a lot of available capital they're looking to deploy right now. And I think for early stage companies, it creates an interesting dynamic because there's a lot more ability to kind of take on private financing rounds and stay private longer, not just a C round or a D round or an E round, but even longer than that. And we see a lot of private companies that and their boards have decided not to sell the company at an early stage, even if there was an attractive valuation on the table from a buyer because they think that they can, raise some capital from sophisticated investors and keep going on the standalone path. And I think, for the early stage companies that have pursued sale transactions this year or thought about it, it also has kind of created a unique dynamic, the pandemic, over the last couple of years, because early stage companies in particular, but most companies, they don't really sell themselves. It's kind of not the way that it works. You get bought as opposed to sold. And the early stage companies, the process is usually not you're hiring a banker and going out and running a big auction process. That's usually deals come from networks and connections and strategic buyers getting to know the entrepreneurs running a business, getting to know the product, using the product. And a lot of that historically has kind of happened in face-to-face meetings and conferences and things like that. And I think people are trying to navigate and figure out the best way to still form those connections, and people are starting to be a little bit more successful with it now that we've been doing it for about a year and a half. But it has caused a little bit of friction, I think, in the dynamic. I know I do both buy side deals and sell side deals, and some of my strategic acquirer clients have kind of put M&A on pause because it's such a different structure for them. Maybe not formally on pause, but they're just not really doing deals as much because they're not used to that dynamic. And then there's others that have, really kind of embraced it and used it as an opportunity to find different ways to get to know people and build their network, which I think is pretty cool too.
Yeah.
Sorry, go ahead, Luke.
Go ahead, Liz.
Well, I was going to say, Rich, you mentioned a few things. I'd love to pull a couple threads, if that's okay.
Yeah.
So you mentioned a little bit like earlier stage companies aren't necessarily sold, they're bought. And so I guess, will you frame up for the audience here and anyone on the panel, like when you say earlier stage, can we qualify what that means a little bit? And how do we think about the environment around valuations? What's that kind of, like, what are you seeing in terms of pricing for early stage deals?
Yeah, I mean, people think about it, it's kind of a different vantage points. Some might say, look at it, how many employees you have or how much revenue you have. But it's going to depend on the strategic buyer most of the time, the valuation they're willing to do. A lot of the early stage companies don't really have the revenue and the EBITDA that makes for a very attractive acquisition target for a private equity sponsor, although there's some private equity sponsors that have kind of moved into more of a growth stage. But for strategics, a lot of times they don't really care about how much revenue you have or what your EBITDA looks like. And they're looking at what is the product you have, how good is the technology, how great is the team, are they smart, have they been around together for a long time, do they work well together, and what can that product and that team do for me and my strategic vision as a strategic acquirer? Will it shorten my roadmap to get into a particular market? Will it reduce my overall cost? I could build the product and go hire a team and build it. How long is that going to take me? How much is it going to cost me? Is this acquisition going to shorten that for me and create some benefits that I wouldn't otherwise have trying to build it myself? And the valuations everyone kind of does their own way of valuing it, but it's usually not tied to, like I said, revenue or anything like that. Some buyers will look at the number of employees and do like, if it's an acqui-hire type transaction, look at the number of engineers and try to price based off of that on a per engineer head. Most of the time though, it's probably looking at what are the cost savings we can have and what are the efficiencies and scale that we can get from bringing on that team and that product, and how does that fit into our strategic mission? So you'll see valuations are kind of all over the map.
It sounds like it's a lot more art than
Totally. Yeah.
In terms of coming up with the valuation, but there is some science and engineering how you get to that kind of outcome. Does that sound about right?
Yeah, and then for the board on the sell side, I think they're looking at what does our future look like as a standalone company? If we do a financing round, what's that valuation going to be? What are the risks to execute and achieve, the next phase of the company? How many people do we got to hire? What's the competitive market dynamics like? all those factors. And then, inevitably people are looking at what's the return to investors and return to the entrepreneurs running the business. And there can be some tension there sometimes too, where, an entrepreneur that has been running a business for a few years is going to make a lot of money for him or her. It's a great opportunity for their family, but the investors maybe thought it was going to be for a longer path or something like that, and they want to push for a longer lead time and building and growing the company more. And for the entrepreneurs, a lot of times they're on the board too, and it's unique dynamic because they have fiduciary duties to try to maximize value for stockholders in any kind of sale transaction. So some competing interests at times that we have to help companies navigate through, but we're able to do it with a lot of times. And the most sophisticated and the best VCs, I think, kind of understand the dynamic with entrepreneurs, that if you want to be able to get in good deals, you got to have good relationships with people running businesses. And sometimes that means you're going to sell the company earlier than you thought.
Absolutely.
Yeah.
And life is long, right? So, there are serial entrepreneurs and buyers become sellers and so on. Well, let's dig into a little bit of the science of like how to actually make something happen. And maybe for starters, we can talk a little bit about how do you plan the steps to give yourself option value. I guess based on the poll earlier to start off the session, there's some folks who are all in on M&A, some are undecided yet. But I think thinking ahead and making sure you're keeping the options open to you is good. So maybe, Luke, I'd love to hear from you on some of the critical elements that may not be very obvious that would be good to put in place, in terms of making a transaction happen.
Yeah, sure. Happy to give some feedback there. I think for the folks who are looking to sell on the webinar today, the most important thing that's going to be beneficial to you as a founder, as the seller, is reps and warranties insurance. It's something that you likely don't know anything about now, or might not know anything about now. You will likely learn a lot about as the process moves forward. And it is essentially breach of contract insurance coverage that looks to enhance or replace the indemnification agreements under the purchase agreement whenever you go to sell yourself. So in some cases it will enhance it. In some cases the policies can actually replace it. What that does, when I say breach of contract insurance, I mean, as a seller, you're going to be making representations and warranties about the state of the company. And there will be a lot of underwriting, a lot of diligence providers will be hired on the buy side to validate what you're saying is true and accurate about the company at the state of sale. The policy will replace the indemnification and corresponding escrow requirements under the agreement. What that means is it allows you as a seller to walk away with roughly 99.9% of proceeds at closing versus 90%. So if you're going to sell a $100 million company, it's better to walk away with 99.5 million versus 90. Obviously, there was myriad other things that go into that, but that's the key thing, I think, from a sell side perspective that you may not know about, but you're going to be considering relatively quickly once you decide to sell yourself. Hopefully, folks like Rich or your banker, if you do happen to have a banker, will let you know about that. Typically, it's going to be come into play when a transaction reaches about $50 million and above in total enterprise value. So just keep that in the back of your mind as well. I think we're going to talk a little bit more in a few minutes about the nitty gritty on the insurances that should be in place, but I don't want to get into that quite yet. That'd be my feedback as far as what to think about as you think about starting to sell yourselves.
Well, I think, Rich, it's funny. Insurance is one of those things where you don't know you want it until you need it. And then when you need it, it's a little bit too late. And growing up as a product of immigrants, my parents thought insurance was like the best product there is out there. Like, this is crazy. We can just pay like whatever it is, like $10 a month. And you're saying that like, if my car has an issue, like you're going to pay most of it. And so I think that certainly applies here in this situation, right, Luke, where again, this, reps and warranties insurance, when you need it, it's probably get it. And so how do you think about like, okay, plan ahead a couple steps? And so maybe if you, just to finish off on that topic, when is the right time to think about it? Like, how would you, for the audience, maybe folks are now looking through their legal drive and saying like, oh, do I have this? And like, what's going on? It's 300 pages. I don't even know. Like, How do you think about the right timing and putting that in place?
I'm still trying to figure out whether or not I should get life insurance because I get solicited for that all the time.
You should.
Maybe someone can give me advice sometime. But
we can talk after this. I think once you cross the chasm of having kids, you want to think about it.
Just get the right.
I get it through Wilson, which is great. They have great benefits. Advisors are always trying to pitch this extra life insurance that I feel like I'm healthy. But anyhow. So rep and warranty insurance is, it's not something that you would buy and just have in the normal day-to-day course of running your business. It's something that you're going to get, that's going to get purchased in connection with a transaction. And the most common one is actually, it's a policy that's bought by the buyer, and maybe sometimes the seller, often the seller will share in the cost of that. It's a negotiated point. We were alluding to it a little bit. The traditional way, going back, 10 years ago, private companies would get bought is there would be some kind of indemnification arrangement that would have a 10% or even a 20% escrow sometimes. And you don't get all your money at closing like we were talking about. And rep and warranty insurance has kind of become a product that has replaced that in a lot of ways. And usually you're going to have to try to negotiate for that kind of dynamic at the term sheet stage or the LOI stage before you ever get into definitive agreements, especially if the buyer is a strategic acquirer. There's a lot of strategic acquirers haven't really gotten behind and adopted a rep and warranty insurance yet because they're so used to doing deals the classic way that they've been doing them for many, many years. But if a target is willing to use its negotiating leverage and indicate that that's really important to the board and to the investors and stockholders that they have a clean deal and not a lot of exposure and not a lot of money tied up. I've been successful in negotiating for rep and warranty insurance policies, but you do got to get it in at the term sheet stage most of the time. Private equity buyers almost have fully adopted doing a rep and warranty insurance deal. It's kind of the norm now. And I kind of expect strategic to be moving in that way over time, but they're a little bit slower to adopt it.
Well, let's broaden out in terms of thinking about what else besides insurance. I think, Chris, you've got a ton of experience, in your work with corporates on the buy side. It sounds like you've also been on the sell side yourself in an operating role. And so I'd love to hear a little bit about how you prepared for diligence. I think this was a question from the audience as well. So I think we'll be able to tackle both a burning question on the audience side and something that's part of the natural conversation.
Yeah, you bet. Yeah, I think going into any diligence, you upfront understand it's time consuming. I think we kind of touched on it a little bit, but you need to kind of think about what advisors you need and pick those wisely. Also, you need to think about your resources that are going to be involved in the deal. You do not want the entire company involved, but you want to pick, a few people that are going to be involved. And also you need to make sure as you're doing that, you want to make sure that you have coverage on running your business, right? Your business is key. You don't want to stumble and have issues there. So managing that, understand it's going to be time consuming and plan accordingly is super important. The other one is really around how do you want to position your company? How do you want to think about that? You're going to have a variety of different buyers looking at you, right? You could be a strategic tuck-in, you might be a private equity play, maybe a SPAC, right? And so when you look at all that, understanding how to best position your company for those prospective buyers is important. The other one that I think we see often that isn't done very well, especially for startups, is really getting your financials in order. Some of you may not even have a finance department. You may outsource a CFO and a group that does that. We see that quite a bit, but really making sure you have the basics down in order, because those are the first things that a prospective buyer is going to ask about. The next one is really around kind of thinking through your strategic plans and how you're going to support the next 2 to 3 years of growth. Like, what are your plans? What's your product roadmap? What's your headcount growth? Are there new markets you're going to grow into? Really kind of having a plan around that, really from an investor standpoint, will bring trust and also show them that you guys are thinking through overall plans. And then the last thing I would touch on is the main focus that you're going to see, especially when you're in a startup world. The focus is really going to be on your revenue, like understanding kind of your revenue that you built up to date, but also what your future revenue plans look like. That's going to be the focus. They're going to look at your product roadmap. They're going to understand what your competitors, what end markets that you're supporting, where are the risks, and really what's the downside case. Because most of these investors are going to go into this knowing that most likely the case you're going to give them is probably a more, I would say, best case option. So they're going to haircut that anyway. So it's important if you come to the table talking about competitors, about your product roadmaps, about some of the investments needed for this growth. It's incredibly important to do that. And again, it just instills more faith and trust in those investors.
Well, Chris, I was smiling when you said that it's important to kind of put out a best image of yourself. The buyers are going to haircut it anyway. I think that also links to something that you said earlier on. You have to think about how best to position your company, right? The details matter, the roadmap matters, the team matters, your financial projections, new areas. But I think the overall story of why your product, why your business matters, and why does it matter to the seller is really important. I'm just curious, like, what are some of the most creative positioning or creative, stories that you've heard before in your experience? Maybe I'll kick it off by you all a little bit of time to think about it. But for us, and I'll just a little bit of insight. When we were selling our Eats business in India, part of it was around subsidies. And so at this time, we had a joke internally. Like if you want to go to India, now's a great time because you're paid to eat food for free and have it delivered to you. And you actually get paid more, right? And so there was a little bit of a story around, hey, look, you can take subsidies out of the market and everyone be more effective from a customer acquisition and a promo standpoint. But the story that was told, right, was like a day in the life or a week in the life of a traveler in India eating off of Zomato, Swiggy, and Uber Eats. And it was like promos after promos after promos. And you string together that like screenshots of these promos. And it was like, oh my gosh, at the end of the week, you're full and you have an extra $100, whatever it is, $100 in your pocket, right? And so there was definitely a little bit of a presentation value and story. And it's not just the like 1 + 1 = like, 1.5 when it comes to cost savings and the nitty gritty. There had to be a little bit of a story and a production around it. So in any case, I'm curious, what like positioning of companies and in sell side situations or even buy side has really kind of stuck with you?
I mean, I'll comment with, I don't have any great cool stories, but I would say what I've seen work well is telling your story and telling it very well is important, right? I think, as you mentioned, and making it personal, make it about some problem you were solving out there in the marketplace, but also tell your story where, hey, we tried this particular thing, but guess what? We ended up way over here. And I think people like to see that you had a plan B or you did the pivot, right? I think people like to see that. I mean, I think all investors everyone has great intentions with a product and they think that they've got the right product for the market and it may be the best one, but that doesn't always mean it's successful. So I think having those stories and making them personable and doing it in a way that really kind of pulls in that buyer is very good.
Liz made a good point in her story, which is, and this my story, which I won't give details on because it's the deal I think was confidential, but it's really, really important to kind of be able to tell your story in a way that resonates with the potential buyer. I had a company a long time ago, it was a few years ago, that they had a product, it was a great product, it was doing good things in the market and everything. And they had a commercial relationship with a strategic that was in a similar space. And like if you just looked at the product that the company was running, it was good for the commercial relationship with the partner, but it wasn't something that they probably would have bought. But the entrepreneurs running the business kind of saw things about the buyer's business that they weren't seeing themselves even, and how you could take the tech that the company had, do some creative, new, unique things, and it could be something that's really, really valuable to the buyer. And the entrepreneurs pitched that kind of story to them. Again, part of building the network and the relationship that I mentioned before. And eventually the strategic ended up acquiring them. It was, you know, for a couple $100 million. It was a really great exit for them. But, you know, that wouldn't have happened without some creative foresight and thinking and nice, you know, spin and explanations that the company was able to put on their business.
So I would say, just my comment on that, I think great points by Rich and Chris. The one thing I would advise is make sure you know who your audience is and who you're talking to when you're pitching certain things about your business or pitching certain areas of business. Just from the insurance side of the equation, you may want to talk differently or pitch your services and operations to, or projected services or operations to a potential investor. When you're talking to the insurance people in the room, you want to be as vanilla as possible and tell them exactly what they want to know and nothing more, nothing less. Sometimes the more information you give, you elicit a lot more questions and it could have a negative impact on your insurance. You don't want to talk about how if you're a SaaS company working in marketing services, you don't want to start talking about aviation and nuclear and all this expansion you're going to be doing in different areas around the country. It's better to stick to that one little bubble. Obviously, you can build the story you want outside of that, but when the insurance people come in, just make sure you know exactly who you're talking to.
Well, I love that. Less is more and more is more, but it really depends on the audience, right?
Exactly.
What else, Luke, on kind of buy side process? I think it's really helpful to hear from your perspective. I think you work with a lot of corporates and sponsor firms on the buy side. So what else on the buy side diligence process have you seen work or not work, or just any learnings to share there?
Yeah, I think so. We work on, like I said, several hundred transactions a year, running the gamut of the investment and transaction spectrum, from your 10, 20, $30 million growth investment all the way up to your $1 billion plus de-SPAC transactions. So when we come in and do diligence on the insurance program, what we tend to find is I'll frame it a different way. Our job is to uncover the landmines that could potentially negatively impact the value of the investment that the buyer is making. So we come in and we say, here's what the company should have in place. Here's what we think it should cost from an underlying operating insurance perspective, such as general liability, property, cyber, employee benefits, professional liability, things like that. What we tend to find is there is a foundation of insurance in place, but it's not quite ready to be the insurance that needs to be in place when a buyer is going to acquire you. And I'm talking about on the private equity side. Venture capital side, a lot of the venture capitalists don't really mind as much. They don't look at insurance because they've got such a small ownership stake anyway. Strategics, they understand that whatever the company has in place, as long as it can go away at close and they can be tucked into their master insurance program, that's fine. But what we tend to find is that several companies when they're putting the insurance program in place, yes, there's a foundation, but some of the key coverages that are missing are expensive. And my reaction to that is, typically after several hundred years in operation, insurance is somewhat of an efficient market. If something's expensive, there's likely a reason why. So for instance, if you're a software company and you are working in an office and you've got 50 employees, your core business insurance is not going to be that expensive. Your cyber liability and your technology errors and omissions insurance will be the large majority of your premium. What we tend to find on the smaller companies and the companies that are about to get in the next phase of growth is they've maybe not insured or not purchased the coverage that's usually pretty critical to their business just because of cost. And they're trying to help their EBITDA margins as much as possible.
Liz, I think it would be good to kind of, I'm seeing some of the questions that are showing up, and it relates to this topic a little bit, to take a step back and talk about what's the process? How does this kind of come together a lot of times? Great. And so it's pretty common that there's like an early conversations between a potential buyer and a company. If you're on the company side, you're going to want to make sure you get an NDA in place pretty early on to protect your confidential information. We can talk a little bit more about that after the fact. But at that stage, a lot of times the potential buyers' diligence focus is going to be on business issues, product, and team. And usually a fairly small team on the buy side that's involved in that, corporate development folks, operating people that are running the relevant business unit. And they're really trying to get a sense of, is there good strategic rationale for the transaction from a business perspective? And then they're going to take that sort of initial business diligence and then go back with their committee or however they have their M&A process that is set up internally, and talk about what's a valuation range at which we'd be willing to transact at, if at all. And then every buyer kind of has their own process and how they go about that. But then they come in and often would have conversations about valuation with the entrepreneurs running the business or members at the board, and try to see if there is a range at which there could be a deal that gets done. Usually the first number they're going to present is not the highest number, like someone mentioned before. So there's almost always going to be room to negotiate. And assuming there's kind of business alignment on what evaluation might look like, then you move to a process where you're negotiating an LOI or a term sheet that has more detailed principal terms. And when you sign that, typically there's an exclusivity provision where the company says that they're not going to go negotiate a financing round, another acquisition, or any other strategic deal with anyone else other than this buyer. And so before you do that on the sell side, you're going to want to make sure, you get lawyers involved, you get accountants involved, advisors involved. It's a board-driven process. The board should definitely be involved in making the decisions. And try to negotiate for the most detailed terms that you're willing to transact at, because the moment you sign exclusivity, a lot of your negotiating leverage goes away. So if there's an important term, like I want to get rep and warranty insurance as part of the deal, as opposed to having a classic indemnity, these are the purchase price adjustments, all that, try to negotiate at the term sheet stage. And then once you sign the term sheet stage, the buyers are going to unleash Chris and me and whoever, all their advisors, on to do a bunch of confirmatory diligence. And they're going to do exactly what Luke just said, which is try to uncover the landmines to see where the risks are and where the warts are, and why does this valuation I agreed to in the term sheet doesn't make sense. And that can run through a whole host of things. It could be IP, it could be, have you not been keeping great financial statements? Have you not been paying your sales taxes? Is the product not what I thought it was, when I got it and I did the sufficient diligence? Do you not actually own the IP? Does it not do what you said it does? There's a lot of different things that people might uncover that could sort of derail a deal in some ways. But most of the time, if you get to the point where you get a term sheet and you're a well-organized and prepared company and you've been thoughtful leading up to it, the buyer's usually not going to find something that would change their mind on the business thesis and the strategic rationale for the transaction. But the diligence process is very cumbersome and very burdensome. And, like Chris was saying, you got to make sure you have the right team members that are involved on that, and it's not overly distracting to the business, and you don't ruin it along the way.
I would also say, if I could add to that, I think understanding as your company, kind of your value, what the kind of the buyer on the other side, what are they going to really value out of your company? And an example is a large semiconductor company. We were helping them due diligence on a pre-revenue company, and they were buying a company that was just engineers, pre-revenue, and it was all focused on their technical capabilities. There was no finance. They didn't have sales, right? They had spend. But it was really focused on the IP. And this ended up being a company that was acquired for $1.4 billion, right? So understanding the value and what you bring, and the IP is super complex in that particular instance.
Chris, you touched on exactly what I was going to ask, which is—
Sorry to jump in on you.
No, it's great. Rich mentioned the process. Thank you for laying that out really well. I am curious, how do you think about price? I mean, it feels like one of those things, it's like in the eye of the beholder. And especially given the current environment that we're in, how do you all think about coming up on that valuation? I think one of the attendees also asked that question. How do you think about the best valuation? How do you think about pricing in this environment? I'm just curious, how you come up with that.
Rich or Luke, do you guys want to jump in on that?
I think it's a function of a few different things. I'll say it should be a board process, a board decision to figure out what the right price is going to be. They should be consulting with advisors and the management team to try to figure out what's the future of this company look like, and what are the potential roadblocks in achieving the goals that we would want in 2, 3, 4 year long-term horizon. And there is kind of an element in some ways, is a gut instinct, like, is this the right price that makes sense for me? A lot of times early stage companies wouldn't get, most of the time actually wouldn't get a banker to render a fairness opinion or something like that in a transaction that says that the price is fair. But when the board makes a decision that they are going to pursue a sale transaction, the duties under Delaware law kind of shift a little bit and say you have to try to maximize price to the extent reasonably attainable. So get the highest reasonably attainable price. And that means you got to have some negotiation and go back and forth and not just accept the first proposal, because like I said, it's usually the first proposal is not going to be the best proposal. But you want to look at comparable transactions, other companies that have been in the space that have been acquired, and what did they get acquired for, not just based off of financial metrics and multiples, but other relevant factors too, like how big was the team, how long had the team been together, how sophisticated was the team, do we have unique patents that someone else might not have. And of course, you should also be looking at the financial multiples and things like that, because that's relevant, and compare that to what your projections might look like for the business going forward, risk adjusted for trying to achieve the goals. And I think just trying to get a general landscape from what has this buyer in the past been willing to pay, to the extent you can kind of figure that out. A lot of transactions, the prices are not publicly available, but if you can, I think that can be helpful and a good measuring point to compare this proposal that you're considering against what this buyer in particular has done in the past, but what the market has done in the past as well.
And I think it kind of goes back to some of the things I said earlier, where kind of early stage companies, there's gonna be a lot of focus on your revenue, right? How defendable is your IPs? How hard is it for a competitor to come in and potentially take market share? Are your growth plans reasonable, right? I think anytime you go for the first few years, you can show tremendous growth, but at some point that does slow a bit, even though it still looks great. But making sure you're being reasonable, they're going to really put a lot of, they're going to test that pretty hard.
Yeah,
I would say mostly by the time we get involved on the insurance side, there's a pretty definitive range that's already been decided upon as far as valuation of the company. So we get insurance and reps and warranties options for that valuation. Well, what I would say is one of the metrics is obviously EBITDA. A lot of people don't understand that the point of insurance fundamentally is to protect your EBITDA. It is to make sure that in the event of a worst case scenario or a claim, the business is not going to go bankrupt, and you're going to have coverage there to fill the hole or the gap that's provided by that loss or that claim, whether or not if it's a true loss or not. So I would just say, as you're thinking about how to before you get to the valuation itself, you're going to want to protect EBITDA as much as possible in case that is the metric that they end up using to evaluate.
Yeah, there is some nuance, I think, to figuring out what are the things that the buyer really cares about, because it might not always be financially driven, especially if it's an early stage company that's pre-revenue and all that, and the buyer might even not even want to run that business anymore. They might want to do something else with the technology, like we were talking about before. But for companies in the technology and life sciences space, I think when I look at the claims and the things that buyers are most worried about trying to get protection, IP is number one on the list. Does the company own the IP? Is there infringement that I could get stuck with later? A lot of buyers worry that, there's this great startup that has this cool product, but they're actually infringing on some third party's IP, but no one's going to sue that startup because they don't have any money that is really worth going after. But the moment that the buyer buys that company, now you got really deep pockets that can fund a multi-billion dollar or $1 million infringement claim or something like that. So IP is number one. A lot of buyers are looking at tax issues. Early stage companies are not always the most sophisticated in how they handle taxes, and not just income taxes, but sales taxes is one of the areas that is really important that I think slipped under the rug a lot of times at early stage companies. And then, like Luke and Chris were talking about, financial statements and making sure all that's accurate. Buyers are also strategic, in particular, can be really focused on reputational risk. So even if something might not be a real big potential monetary liability, if it could harm their reputation, that's even worse sometimes. I've seen some deals fall apart because the company didn't have a great culture, the great product and everything, but not a great culture, and wasn't great to women or wasn't great to minorities, some sexual harassment things. I've seen at least 2 or 3 deals break up because of issues around that. And when you take a step back and you look at it, the monetary claims probably not all that big in the grand scheme of things, but no buyer wants to be associated with that kind of culture. There's other great companies that you can buy and focus on and not have to take on that baggage. So
I would also say contracts are another area of that will be a focus too, right?
That's true, Chris.
That you need to have tightened up, and making sure you have legitimate contracts in place and not handshakes in place, right? And then you have, your employee base. There's some type of employment contract in place as well.
Yeah, buyers really, really don't like to see things like, and Liz, you probably could speak to this given your experience at Uber, but MFNs or exclusivity provisions or contracts that purport to bind all affiliates of the target company. It's kind of hard because a lot of times early stage companies don't have a lot of leverage in negotiating against their customers, especially if they're bigger customers. But
yeah, that's right.
Well, I think in knowing what to avoid, there's a lot of good advice there. Maybe last question before we turn over to Q&A. If you had to give one piece of advice, or let's make this fun come full circle, if you want to answer this question instead, that's fine. What are you dressing up for as Halloween? Answer one of the two and we'll close it off before we move to Q&A. Piece of advice or your Halloween.
I like the Halloween question. I'll let Chris and Luke give good advice. There's currently a negotiation going on in our house right now. We're trying to get my daughters 3.5 to agree to go as Red Riding Hood so that our son can be the wolf, I'll be the father, and my wife is the grandmother. But I don't know, there's these YouTube videos out there that do like the old Grimm's Tale kind of fairy tales in like a real classic way that can be kind of gritty. And my wife showed my daughter the Red Riding Hood one like a few months ago. She's definitely afraid of Red Riding Hood now somewhere. But we're still, for some reason, trying to get her to agree to that. So.
Excellent. My practical advice for the Halloween first, then I'll get into the business. Try to refrain from telling your kids they can be whatever they want, including, I didn't realize that statement included inanimate objects, but now my twin boys who are almost 3, all they want to be is a fire truck. And it's just, we're trying to pitch them on firemen, nope, fire truck or train, either one. So that's a fun thing in the Parsons household we're dealing with over the next couple of weeks. No, but from a business perspective, I think who you hire as your advisors really matters. And I think there are several, and there are many specialist advisors who are very good at working alongside investors and private equity and venture capital, both on the buy and the sell side. So my piece of advice would just be to seek out and find an advisor partner who identifies what you're trying to do long-term and can help you in that area, whatever that specific area may be. Myself, I'm obviously the insurance guy in the room. We work on a lot of deals and we know exactly what buyers and sellers want to see from an insurance perspective. And so I would couch it as from an insurance perspective, making sure you're building a better than average foundation. So when the buyer does come in, it's a box to check versus a lengthy conversation you have to have on the insurance side of the equation.
Great. I'm just thinking, my Halloween, I guess, story, I've got a 10-year-old and she's probably near ending her Halloween kind of days. But last year she went as a grandmother and she had a cane and a wig and all that. And she loved it. And this year she's decided to go for as a grandfather. So that's what she's doing. So I'm sure it'll be funny and cute. My advice I'd leave you with, and some I've mentioned, is, I think first one is really kind of get your house in order, right? It's a lot of work. You're going to need to enlist outside advisors, figure out where you need help, and get ready for it, right? The other one is really, and I didn't talk about it explicitly, but really don't forget to, not only tell your story well, but also emphasize your team. They're not just buying IP, they're buying your company, which is made up of people, right? And those people have unique skill sets. So making sure you talk about the team and what they bring to the table and their skill sets and what they've done, I think that's important. And the last piece of advice I would leave you with that I often see as kind of a miss is just know your numbers. Know them well. You don't need to know them on the spot all the time, but if you can't answer the basics, that's not great either.
Yeah, and on the point that Chris made, I think as you start to build and grow your company, I think a lot of entrepreneurs can kind of be very focused on cost savings, rightfully so, because you have limited resources. But it really can add a lot of value to engage like a sophisticated law firm that's used to working with early stage companies, and an accountant that's also used to working in the same space, just to make sure that you have the right IP assignment provisions in your contracts, you have the right employment agreements, you have the right policies in place, kind of really, and you have the right certificate of incorporation, you were formed right, all these different things, your option plan works the right way. There's a lot of housekeeping issues there. If you just kind of set the deck in the right way, when you play the game later, it's going to go a lot more in your favor.
Well, thanks folks for all of that. I think we've answered some questions along the way, but anyone else in the attendees group, please ask your questions. There were a couple pre-submitted questions that actually follow on to something, Luke, that you mentioned. So I'll just ask it to the group, and then attendees, anyone else, please put your questions in the Q&A box. But Luke, earlier, your advice that you mentioned was hiring the right team, the right set of advisors is really key. One of the pre-submitted questions is, can you give advice on finding the right M&A partner, advice on when to use an investment banker? How do you select the right one for your company? Rich, Luke, Chris, if you all have thoughts on that, that'd be helpful.
I'm going to let Chris and Rich take that one. On the, again, unfortunately, on the insurance side of the equation, usually when it gets to the stage where we get involved in the transaction, either on the sell side or the buy side, that bridge has been crossed, and I don't have to worry about that a lot of the time.
And what was the question? The question was related to when to bring on an advisor.
Yeah, how do you find the right M&A partner, or like how do you find the right advisor, investment banker? How do you select one?
Yeah, I mean, I think you have to look at, there's some advisors that are better for certain, industries, right? So you look there first, right? And then look for, if you're looking for someone, let's say like what I do, right? Like what type of diligence are you looking for? If you're needing that kind of help with diligence, or help kind of getting things set up, or thinking about getting your company set up for, a potential sell, like think about those elements. And there's a variety of advisors, right? And they have a variety of costs, right? Obviously the bigger ones are going to be more, and then there's smaller ones that are less. So you have to kind of find the one that fits what you're looking for. But I would also strongly suggest that, don't go into this with I'm going to take the cheapest option, because it could be very expensive for you.
Yeah, I mean, when you think about trying to select the law firm, usually the lawyers are going to be the advisors that are driving a majority of the process along the way. Bankers sometimes too, their kind of function, which we can talk about in a minute. But M&A deals, kind of by their nature, are pretty complex and big, and you get into every little issue that a company has to deal with. So I'm perhaps biased, but I think it's really helpful to work with a law firm that has experts in a variety of different areas that are relevant to your business. So you wouldn't necessarily want to just work with a single lawyer that does some M&A all the time, but isn't an expert in IP and tax and anti-corruption and export control, every kind of little legal issue. A normal deal, when we do it, we'll staff it up, and there'll be a core M&A team that's very sophisticated in running M&A deals. But then there's also a team of 10, 15 other lawyers at the firm that have expertise in all these different areas: IP, privacy, employment, benefits, et cetera. And that goes a really long way, because the buyer's looking at all that in their diligence, and they're negotiating points around all that. And if you don't have someone that knows what they're talking about and sophisticated and can help you navigate that process in an efficient way, a lot of times it creates issues, and you're not going to get the best transaction that you probably otherwise would have gotten. And then I totally agree with Chris. With bankers, you want to find somebody that knows the industry and knows not just like the space technically, but also has relationships with potential buyers. A lot of times the way bankers will operate is, they kind of leverage their network, and they pick up the phone and they call person X at company Y, and they know that relationship, and it's a lot easier and more successful than just cold calling and sending random emails to people. So getting a banker that's in the space, that knows the space, that knows the players, is going to be really, really beneficial. And then, cost is always something that is relevant. Most of the time, bankers are going to be able to help you negotiate and create a better deal, and it's worth the fee at the end of the day. But some companies are not going to get sold for $1 billion. They're going to get sold for $50 million or $100 million, and it probably doesn't make sense to hire Goldman Sachs on that $50 million deal if you can get them to work on it. So you kind of got to be thoughtful in that way too. And I think also when selecting individual humans to be your advisor, not just the firm, I would focus on personalities and trying to see if you connect with people and you fit with them, and that they can be a person that can give you the advice that you need to hear, not necessarily advice that you want to hear, and do it in a way that can resonate with you. Because like I said, there's a lot of important decisions to make along the way, and having somebody that can talk with you in a straight way that's easy for you to understand and grasp can be really important.
And also
Well,
leverage your network too, right? Like reach out to other people that have been kind of in your shoes and need to find advisors who they trust and why. Help create a key list of questions that are important, right? Like kind of, you have to almost do that due diligence a little bit as well. It'll go a long way.
Well, I was going to say thank you for all of that. I'm going to ask the last question here. I feel like my biggest value as moderators is to make sure we stay on time. So I've got my watch on today. So last question. This question's for everyone, but what surprised you most about how the M&A market has changed this year?
I think when the pandemic happened originally, there was a lot of concern that M&A markets were going to just kind of come to a grinding halt, and they slowed down for a few months. But after that, the M&A market has been exceptionally busy, and I think record levels of volume and transaction values and stuff like that. So I was surprised at how active people have been. The de-SPAC transactions have definitely added to that. But even if you took those out of the equations, I think the M&A markets would still be higher than they have been historically, which is really interesting.
Yeah, I would agree with that. I think, M&A, if I think about specifically kind of, high tech and healthcare life science has just been, growing and, setting records and doing extremely well. And, and it appears it's going to be the case going into next year as well. And I think with SPACs, SPACs are kind of came out of nowhere, and they've had incredible growth from, going from 2019 to hardly anything to 20 to even early 21. But it's still, SPACs are a small percentage of the overall kind of, if you think about, kind of traditional M&A and PE-led, M&A as well as IPO. SPACs are still smaller as on a percentage, but they have slowed, like I said. But I think it's been incredible to see the continued growth and the activity in the M&A market. It's, we as KPMG and do everything from financial due diligence to operational due diligence to integration. I mean, we've continued to stay busy for the last, 14, 15 months.
I would echo the exact same thing that Rich and Chris said. March of last year, we thought the M&A market and the IPO market was going to fall off a cliff. It did for several months. And then since then, it's come back, and we've done more deals in the past year than I've done in the past several years. And I don't see it slowing down at all, especially with the potential tax legislation that's coming out. I think anybody that's trying to sell their company that doesn't want to wait a couple of years will try to do it before the end of the year. And like Chris said, I don't really see it slowing down once everybody gets over the hurdle of that initial bill. I think 2022 is going to be just as busy, if not busier, than 2021.
Awesome. Well, I think that's all we have time for. Go ahead, Colin.
Well, thank you, Liz, Chris, Rich, and Luke, for sharing your insights on the early stage M&A strategies. We really appreciate you all dedicating time and sharing some of your wisdom and insights. It's really happy to hear all of it, and also glad to hear about your Halloween costume. So thanks again for joining us. For those of you on the call, if you want to meet or have any follow-up questions for anybody, there's a quick poll that we'd like you to fill out. But for Liz, Chris, Rich, and Luke, thank you so much. Up next, for those of you still on, we're going to take a quick break before our growth through acquisition panel. So please take a time to refill your coffee cups and take a quick stretch. We're going to return shortly at 11:50 a.m. Pacific. So we'll see you very soon, and looking forward to our next panel. Thanks again, everyone. Alrighty, everyone, welcome back. Friendly reminder, we're going to be opening up for live Q&A at the end of this panel, so please submit your questions in the Q&A function, not the chat, at the bottom of your screen throughout the presentation. We hope all the information that provided by our experts so far is timely and valuable, and as we mentioned at the beginning of this, half of you are looking to learn more about the buy side, so you're in for a treat. We look forward to staying in touch as your growth continues. So if you're interested in booking a meeting with anyone that you've heard today, just please use the link in the chat. As you settle back in from your coffee break, we're going to launch a poll to just let us know how many acquisitions are you planning in the next few months? 0, 1 to 3, 3 to 5, 5 to 10. Let us know how you're thinking about the buy side and what Q4 looks like. So thank you for participating. We're going to let this go in a little bit, but we've got so much great content to cover, so don't want to let this run too long. Thank you for voting. I'm going to end this poll and share those results. Well, looks like the majority of you are planning on 1 to 3, so great. Thank you for sharing that. Let's see. Get rid of that. So without any further delay, please join me in giving a warm welcome to our guest for this next panel. Our moderator is Saran. She's the SVP of Corporate Development at Viacom CBS. We've got John, who's a Managing Director at KPMG. We've got Jackie, who's Associate of M&A at Wilson Sonsini. And we've got Yelena, who's the Vice President, Transactional Insurance, M&A, and IPO Risk at Woodruff Sawyer. Team, welcome, everyone.
Thank you, Colin. I'm very excited to be back to moderating this panel again, and thank you for having me back. My name is Saran Tanilian. I'm an SVP of Corporate Development in M&A at Viacom CBS, as Colin mentioned. My focus is on sourcing and executing M&A activity across organization, acquisitions, investments, JVs, etc. I've prior to Viacom CBS, I spent a number of years in media and telecom investment banking at UBS. With that, I'll turn it over to John.
Hi, everyone. John Milner with KPMG's Deal Advisory Practice. And I advise my clients through M&A transactions, largely on the buy side, but a little bit on the sell side. And a lot of my efforts are focused around the pre-signing efforts. So think about deal strategy and due diligence, and then continuing on into the post-close world, where we start thinking about and helping out with integration and value capture plans. I work with both private equity and corporate acquirers, largely focused on the technology industry, and a portion of my practice is focused around supporting growth equity investors in late-stage investments they have. Happy to be on this panel with a lot of similar folks.
And turning it over to Jackie.
Sure. So I'm Jackie Hamilton. I'm a senior associate in the M&A group at Wilson Sonsini. A fairly wide-ranging M&A practice. Do a fair mix of work for both serial acquirers and sell-side companies of various sizes. Almost exclusively in the tech space, a little bit of life sciences. Basically, I love it all. Excited to be here.
Wonderful, thank you. And Yelena?
Yeah, hi, good afternoon, everyone, or good morning, depending where you are. My name is Yelena Dunayevsky. I'm Vice President of Transactional Insurance at Woodruff Sawyer, where I work with many private and public companies to structure their insurance solutions. And that includes their representations and warranties insurance for their M&A deals, and also their directors and officers insurance for their IPOs. I also specialize in SPAC insurance and lead multiple firm-wide efforts relating to SPACs. And I've practiced previously as a corporate securities and M&A attorney prior to becoming an insurance broker. So that gives me a really good idea of the kinds of risks my clients are facing. And I do a lot of writing and speaking in the areas of D&O and M&A insurance. And my firm, Woodruff Sawyer, is a leading independent insurance brokerage firm that, you guessed it, specializes in insurance for IPOs, SPACs, and M&A deals. And I'm happy to be here. Thank you.
Wonderful. Thank you, Yelena. Why don't we dig right into the session? We'll start off with just a broad question for this group. I mean, you know, the last time we sat around this virtual table, it was about 6 months ago. We had a good discussion around the trends around buy-side M&A. Would love to hear just how things have changed since then and what hasn't changed. Maybe we'll start off with you, John.
Yeah, thanks. I mean, 6 months ago, I probably had the same story that I'm going to have today, which is the market's continuing to move faster. There's a lot more competition. We thought it couldn't get more competitive 6 months ago, but it only has. And so that competition, that speed is really playing out. It's continuing. You're starting to see, so one, that's a factor that's happening. I think adding to that is I'm starting to see a lot more late stage sellers that are running kind of dual track processes. So they are going and saying, let me pick, do I want to go an IPO route or an M&A route? And let me see which one's going to give me the highest value as a seller. And that's causing more volume in the market as companies are deciding which route to go. And then, I think third is buyers have become really confident and comfortable with doing deals in a virtual world. Something I never thought possible when kind of COVID all set in a year and a half or so ago, but now it seems to become just standard that everything's going to be virtual, and maybe there's one meeting for a set of handshakes, which I think is just crazy for M&A, but I'm seeing it across the board.
Very interesting.
I don't know what others are seeing.
Certainly have seen that dynamic. Jackie, what's your take?
Yeah, I mean, I think it's hard to really add to that. I think that's exactly right. Things really haven't changed in the last 6 months, other than to just maintain that incredibly busy atmosphere. And I think, if there was a group of people who was not yet busy 6 months ago, I think they probably are now. So I think it's like everyone in the M&A landscape. I will say, I think it's very much still a seller's market in many ways. I think there's a bit of a shift in the competitive landscape, just in the valuations you're seeing, and John can probably speak a little more to that. But I don't think that I've seen anything that's just truly, it's from 10 to maybe 300 million. We have no idea. Like, I think there's some element of rationality that's back a little bit. But yeah, just continuing to be very busy.
Yeah. And from a rep and warranty insurance perspective, Yelena, how would you characterize it?
Yeah, I would agree with that. From where I'm sitting, the market started going a little bit crazy in December of 2020 and hasn't really stopped. So we've been seeing the same pace since December going into the year. And honestly, everyone's just exhausted at this point. But unfortunately, Q4, as you know, is the busiest time of deal activity for M&A generally. So it's not going to be slowing down, at least going into the end of the year for sure. And specifically on the reps and warranties market side, what this has done is it took the reps and warranties market from being a very competitive market beginning of the year and into the spring to almost 180 degrees now being a very difficult market, where there's so much demand for reps and warranties insurance across the board that the existing insurers are really struggling to even look at the deals submissions, or are really driving up pricing, and the term negotiation has got down significantly. So it's really become a very difficult market. And the other element I would echo on what John was saying about double track kind of approach from the sellers. I'm actually seeing a triple track approach from where I'm sitting, because one of the additional elements is the potential exit through a SPAC, and everyone's either looking at a traditional IPO, a SPAC, or an M&A deal. And so that's another element that's driving up the competition, with the number of SPACs that are in the market also vying for those same private targets.
And on that note, Yelena, when we had our spring discussion, there was certainly lots of buzz around SPACs. How have you found the sort of the chatter to have evolved since then? Has it calmed down? Has the market calmed down? Does it remain busy? How would you characterize it?
So I would say it has definitely slowed down after April. There's just been some announcements from the SEC and a lot of negative attention on the market. So the IPO activity has really calmed down significantly. There's some numbers that have been thrown out there, 90% down from what was happening in Q1 and Q2 of this year. And I'm definitely seeing that. On the flip side, however, the folks that have already gone public through an IPO, there are 400, I have some numbers here, there are 468 SPACs out there that have already IPO'd and are looking to buy. So those are the teams that have an expiration date, at 18 or 24-month expiration date. A lot of them went public in the beginning of the year. So they're all essentially running around trying to find a target right now. So that activity has really picked up.
No, that makes a lot of sense. Jackie and John, are you seeing anything different out there from your purview?
Yeah, so I'll jump in here. So I do think I echo Yelena that the SPAC boom of late 2020, early Q1 2021 has certainly calmed down. But as she pointed out, there's still a ton of SPACs in the market. They have this expiration date. In order for them to really be lucrative, they've got to find a target. And so I think what, from an M&A perspective, it's look, M&A teams are still doing the de-SPAC transactions, even though they're a little bit different. And I think there's a different vibe insofar as they're a merger and an IPO sort of rolled into one. But then what they really are for a company, right, is I think it's more similar to a financing event, a significant amount of money often, plus going public. And so I think you end up with a situation where valuations, even though I said in the prior answer that some of the valuations have calmed down, I think this is still a place where you're seeing pretty high valuations because it's not quite, I don't want to say it's play money because it's certainly not, but it's not as tangible or immediate, I should say. And I think, they're also, we'll get to this later, but just sort of echoing the thing that you're going to hear throughout this entire, panel is, folks are very busy, and I think de-SPACs in particular, because they're so complicated, they're sucking up a ton of resources and advisors across like the entire M&A landscape, right? So a typical deal, it has, some sort of subset of people, but now you need, 3 times the number of auditors because this is going to be both an IPO and an M&A transaction. So you've got all sorts of financial statements, et cetera. And so I think it's still a very interesting landscape out there for SPACs.
Yeah, no doubt about that.
I would just add that that's exactly right. The fact that there's an IPO and an M&A component makes it a really difficult or tricky sort of a transaction, which brings with it a ton of risk and a ton of new elements to take a look at from an advisory perspective for everyone that's involved. And on that point, I'll do a quick plug. I'm actually starting launching a blog series at the end of October that's going to be focusing on SPACs and insurance and risk around SPACs specifically. So for those of you who are interested, please reach out to me after the webinar, and I'd be glad to put you on that list.
Wonderful. Thank you, Yelena. Thank you, Jackie.
I think the only thing I would add real quickly there is I'm seeing more folks be a little bit more cautious about the de-SPAC transaction. Their sellers are becoming a little bit more worried about the SPAC's ability to complete the deal, whether it be raise the pipe or actually get the shareholder approvals necessary. And so that completion risk is becoming much larger because you've seen some pretty public faults in the market so far that are definitely spooking some people there. And then I think the second thing, which has been touched on, is it really thrusts small companies into the public view very, very quickly. And I think we've started to see, again, some faults where companies are saying that might not be so easy as we thought it was to become a public company so quickly, that they're rethinking whether or not that is the right exit opportunity for them, their stakeholders, and their employees.
No, fair enough. And John, staying on you while we're there, I mean, just as you touched on this a little bit in your introductory remarks, but as you think about what's keeping you busy now versus earlier this year versus last year, has that mix changed? I mean, obviously the bandwidth is continues to be fairly constrained, but has sort of the mix of the types of deals you're looking at changed as well?
I'm not sure that the mix has. I think, one, we're incredibly busy, and you've heard it from everybody, and you're going to continue to hear it, that the bandwidth is crazy. We talk about deals moving very fast and the speed picking up, but what we're really talking about is from when everybody kicks off diligence, LOI, everything else. The actual period of a transaction, I think, is actually getting longer because it's taking much longer for buyers to get their accountants, their lawyers, their insurers, all their other advisors in line to kick off work. And so it's becoming really hard for buyers to participate in the market if they don't, basically line up all their advisors really quickly and have the lead time, because a lot of folks are saying, no, I can't help you next week, which is what we used to be able to get calls and start tomorrow or next week. Now it's a couple weeks out, and I'm hearing it across all the spectrum of advisors. So that's, I think, the most challenging thing for buyers right now is actually finding people, because we're busy, everybody's busy. Hasn't changed, but you just can't find advisors now. It's crazy.
It's a tough problem to be in. I mean, and Yelena, I think this sort of flows into what you mentioned earlier, kind of around the rep and warranty insurance market being incredibly busy as well, and needing to be more picky in terms of the deals that you are spending time on. I mean, has that sort of translated to a change in your sort of workflow, and that there's more time being spent around now determining kind of where to put your resources as you look at kind of inbound interest for rep and warranty insurance?
Yes, very, very much so, I would say. And John, exactly what I was going to mention as well. You touched on that. The deal moves really quickly once you get going. But to get going, you really need to do a lot more prep and really start working with people really ahead of time, because it just takes a lot longer now, even for us to go out to the insurers. There are 23 insurers in the market now. They are taking longer to review those submissions. They are taking longer to get back to us. We need to, keep calling them and keep calling them. I mean, I'll give you an example. In April, out of those 23 insurers, I would send out a request for a quote and I would get 19 responses. Now I send out a request for a quote. I have to call, I have to email, I have to follow up. And if I get 2, 3, or 4 responses, that's a good day. That's a good day. So unfortunately, that's where the market has gotten. And I think there was a question I saw in the chat, someone that was asking how the reps and warranties insurers are looking at which deals to pick. That's a really good question, right? They have so many deals coming at them. The bandwidth is very limited. So I can tell you that the smaller deals that used to be fine in the market a few months ago, like a $5 million limit deal, are no longer something that insurers are really willing to look at, because they have multiple others they can choose from. On the flip side, they don't want to sometimes get involved in super large deals either, because that brings in a lot of their bandwidth, a lot of their staff, which are limited right now. And so they're really looking sort of for like this Goldilocks kind of a deal, where it's middle of the price range. It's not really super tricky. It's it's in the industries that are not tricky, like they don't want to be seeing crypto, or they don't want to be seeing I don't know, guns, or a lot of international operations, or banking, things like that. So they really can pick and choose the ones that they want and the ones that they find or feel are less risky. So it's really become quite a difficult market right now. But that's to be expected. So where we'll go from here, I think towards the end of the year, it's going to continue being like this, and I'm hoping there's going to be a little bit of an ease going into 2022.
Yeah, no, that makes sense.
One thing to add there real quick that I thought was really interesting tidbit to what you were saying. I just had a deal where the entire diligence timeline was dictated by the R&W insurers, and the timeline that they needed to bring it all forward. And the client was so, needed the insurance. It was part of the deal and everything, that became the number one part in getting through diligence, was getting everything so early to the insurers because of the backlog. Something I hadn't seen until literally a month ago.
See, I never want to be the person that holds up the deal. So that's never a situation where we want to be. So that prep time is incredibly important.
But it does, I mean, to be fair, it does provide a lever for the buyer, right? And that to say, look, we need this diligence. The insurer needs it to sort of complete their work and get this done. It's sort of that additional lever to move forward in the diligence. So it could be helpful.
I'll jump in. I'll say that I think that's exactly right. That I think that is a lever that buyers are able to pull. And I think where diligence falters, right? I have this as a later question, but where companies are maybe because it's such a seller's market, somebody might not be totally up to speed on their diligence. They might not have thought they're going to be a target in the next 6 to 12 months, so they don't have a full data room. They haven't done that process, and all of a sudden they get a great inbound offer, and it's like, gotta take it. This is what we're doing. and then like heads explode, right? Because everyone's trying, like everyone's just running around. They're still doing their full-time job. They haven't beefed up their advisors teams yet, to John's point that it takes a bunch of time. And all of a sudden, like, well, can we live without that diligence? Maybe you could pressure a buyer, but you can't pressure an insurer. You got to have the diligence ready. So I think it's a really interesting time, just given, the sellers in the market and just how many there are.
Yeah. No, for sure. And Jackie, since we're speaking, I mean, from your perspective, from a legal standpoint, kind of what are some other trends that you're seeing? I don't know, how buyers are thinking about antitrust and other sort of dynamics from the legal side.
Sure. So I think antitrust is obviously a huge one. Obviously, there's been changes and even more proposed changes as the Biden administration has taken over. So we'll say at the outset, right, I think it's a significant concern for larger transactions that are going to meet that HSR threshold, which is currently, I think, is $92 million. So it's not applicable to everyone, which I think is an important point to note. But obviously, when it is applicable, it's very applicable. It's something you've got to do. And I think the underlying point here is just, again, I'm just going to reiterate the thing we've said. Antitrust agencies, just like everyone else in this M&A landscape, they're overwhelmed, right? And so I think early termination, it's no longer a possibility. That's just words that doesn't mean anything anymore. And the 30-day waiting period, when we're still sort of in a world where the 30-day waiting period exists, but it's not really guaranteed in the same way, particularly for like larger transactions where there might be some actual concern. We've seen regulators just ask companies to pull and refile simply because they say, look, we haven't had time to finish our work, or we were kind of fighting internally across agencies about who was going to handle, and we just haven't finished. And so what that turns into, right, is if you pull and refile, it's kind of seen as a soft second request, maybe. So you want to comply, right? You never want to tell a regulator no, but then that impacts how you're thinking about your deal. And so all of a sudden you're getting these emails and you're like, oh, what did I do in my transaction? You're calling your lawyers. And what I think is tangible and what people have definitely done, almost day one as the administrative changes took over, is you're seeing drop dead dates where you might think, oh, this was a pretty simple transaction, 3 months, 6 months, something. I did a deal where we thought 3-4 months tops, maybe. Sure. I think we put a year in there, just, and there's no antitrust risk, right? No one thought there was any risk at all, but it's kind of like, well, we don't want either side to be able to walk from this deal if for some reason, that becomes an issue. The other thing I think, many players in the M&A market are starting to think about tax reforms. Sellers, right, are thinking about how, if tax rates go up, it's not going to be as much money for them, and so therefore buyers are pushing to get things done faster. I think there was a big thought a few months ago that this was really going to happen maybe immediately. I think that's gone away a little bit just because of what's that is not the number one focus. But I still think it's a huge concern of everyone in the landscape. I mean, you never. I haven't done a deal in a couple of months where that's not at least one of the top 5 things talked about at the outset.
Yeah, it does seem to point towards an even busier Q4 this year. Potentially, right. Folks are trying to get that in before year end, not knowing what comes next year. So, I mean, this may be a good time to also touch on a topic I think that was sort of previewed earlier, which is to say, it feels like kind of the beginning parts of the process are getting extended as you try to go out and get advisors lined up and have all of that in place before you can start a process from a sell side standpoint. And then the back end of it, in terms of approvals and such, are being caught up in kind of this potential delays in approval. Are you seeing then overall, and it's more of a broad question to the group, but are you seeing then the overall beginning to end deal process taking longer in your deals? Are you seeing other parts of it sort of by nature contract a little bit so that you're kind of ending up in the same place? What are some of the kind of timing and process dynamics that you're seeing out there?
Yeah, I mean, I'll let other folks jump in just a second. I'll just say yes. The answer is yes. I think things are taking longer, and that's hard because that makes, I mean, if things take longer, they're going to cost more in every way, and then you're not focused on the business. I mean, it's just that's certainly true. And I think as I know that our team is very focused on trying where possible to do things, faster and more efficient, and just say, look, like, we're not going to have 10 turns of the purchase agreement from, 5 on each side. Like, let's just not do that, because that's something we can control. So let's sort of try to build around these other processes that, that we don't have control of. And I think trying to set expectations it's always important, but I think it's really important to say, across, like, I think there's probably more, one thing a positive is that I've seen deal teams work across, both internal, like, buy side deal teams, but also across, like, sellers and buyers, the lawyers and other advisors working together, because no one wants unhappy clients, right? And so I think there is more of a, like, we're in this together. But yeah, things are certainly taking longer.
Right. There's definitely a lot of.
Go ahead.
All right, I'll go and then you go. There's definitely a lot of collaboration between different parties that are in the deal, and I see that more and more. But I would say that the one thing that I've noticed recently is that the deals that are taking longer are typically driven by sort of first-time strategic buyers, at least on where the rep and warranty insurance comes in. A lot of it is driven by sort of inexperience of dealing with the rep's product, but also with sort of running the deal. Perhaps they have a smaller team, or they don't do many transactions during the year. And then on the flip side, a lot of our strategic buyers that we've worked with, for multiple deals, they have it down like clockwork. They have their weeks planned out, and they sign on the date that they mean to sign, and they close on the date that they mean to sign. So it really sort of depends on the team that you're working with. And we do have a lot of first-time strategic buyers that we, do a little bit more sort of hand-holding with, and that's totally fine. But for them, it takes a little bit longer just to kind of get through those steps, understand why things need to be done the way that they need to be done, or how the process works. Once they get it, the next deal runs a lot faster.
Right. No, I can imagine.
I mean, I echo what both Jackie and Elena were saying. I think there's another element to this too that we painted too broad of a brush on. I think when I see deals moving fast, they're for really high quality assets. So for really good assets in the market, I'm still seeing buyers come in and preempt the bidding process, trying to take it away before any of their competition can get ahead of the process that even the sellers have created. And so I think that's causing some things to speed up and continue going. The flip side to that is I think we're getting a lot of assets that aren't worth the valuations, and they're taking a very long time in the process. Buyers are sniffing around saying, do I really like this? And they'll go through 1 or 2 failed rounds, and then by the time they find the third person, it's taking 6 months to due diligence here, because the buyers are starting to get more skeptical, trying to really understand what's here. And so I think you've got 2 different populations of sellers that are driving that. I think the other element is it can be quick to get to sign. And then to Jackie's point, it's getting through all the approvals. Like that sign to close period is getting longer, maybe not so your LOI to sign date.
Right.
Yeah. Well, one other point that I'll just make here about things that are taking longer is I think folks are sort of structuring things in a way that, they're trying to be unique for whatever reason. So obviously, like de-SPAC transactions just carry with them, right? Like I had never, done a double dummy before, right? And that's a commonplace occurrence in de-SPAC land. So I think you end up with that requires a lot of coordination with filings and setting up merger subsidiaries. So I think when you're just doing a traditional, doing a reverse triangular merger, like that's easy. When you start trying to get people to do multiple sets of F reorgs and things like that, it's going to confuse, like everyone around the table has to understand generally everyone around the table has to understand at some level what's going on, and that takes time. And then executing on that, right? So if it's just file one merger sub, you form an entity and you do a merger, that's pretty easy. But when you've got 8 or 10 steps, that it's they have to go in a certain order. And I think that becomes much more complicated for everyone involved, right? So I do think that more complicated things are going to take more time.
Right. No, for sure. So maybe just shifting a little bit the discussion to valuation. I know this was valuation was floated earlier, but John, kind of, what are you seeing in terms of valuations out there, and kind of what's driving valuations? And I'm sort of curious to hear how the valuations you're seeing today are kind of comparing to earlier this year versus, a few years back. Kind of, are we at a high point? What's the dynamic there?
Yeah, it's been really interesting. I mean, I think, and I speak mostly in technology land, valuations are at all times highs, if not really close to it. But I really think that run up occurred maybe 12 months ago, 9 months ago, and that over the last, call it 9 or so months, you've just seen a continuation, maybe a slow increase in those valuations across the board, but there's just been a very lofty market for a very long period of time. As I think that's bringing a lot of assets to the market that probably don't demand that kind of level of valuation, but they think they can get there. And I think, again, that's kind of the general, call it the average valuation there. You still have a lot of very crazy numbers being thrown around on specific transactions, which, in my world kind of sometimes don't make sense. And I hope that the buyers figured out how they make sense. I mean, I've seen some where we're working with a buyer at some crazy multiple and figure out that they don't move forward, and the person that actually won that was multiple turns of EBITDA higher. Well, then not even EBITDA, it's not even a profitable business, revenue higher. It was just, you paid what? There's a lot of that on kind of the edges, but so you get the headlines that there's a lot of valuation pressure, things are very lofty. On the whole, I think it's kind of leveled out over the last 9 or so months. I think that's just because there's too much cash on corporate balance sheets, and there's a lot of PE dry powder, and those are investment professionals that have to put it to work in good markets and bad markets. And so you've got a lot of demand for assets to buy, and in our interest rate environment today, everybody's looking for some sort of a return. Whether you want to think about it in yield or not, you've got to find a return, and so you're paying up for it. I think that's going to continue on for the future. I don't see what's going to happen over the next 12 months outside of some massive systemic crash that's going to change this. It's going to be really interesting.
Well, I mean, I think Jackie brought up the question around sort of the expectations around taxation, et cetera. Do you see that as a factor from your set of clients as well? Are they factoring that in as they think about valuation?
Some do. I think I heard more about it, frankly, a year ago, when everybody was worried what was going to happen around the election and not knowing what 2021 was going to bring, and try to get things closed in 2020. I've heard less about it as every month in 21 has marched on. There was a lot of noise kind of early in the year of, is Biden going to change capital gains? Is it going to be somewhat retroactive to some other period earlier in 21? I think a lot of that's died down. I think now it's just people are looking for assets that make sense. I think the financial buyers out there just have got too much dry powder, and they got to go spend it on things. And so they're looking at absolutely everything.
Yeah. On a related note, not to jump ahead, but this sort of folds into the question of valuation, but are the metrics that buyers are considering when getting comfortable with valuation, have those metrics changed fundamentally? Is it still revenue multiples, et cetera? How is there anything sort of unusual happening in that area?
I wouldn't say unusual. I think the metrics are the same metrics that everybody looked at for the last 5-10 years, forever, which, it's going to be bookings growth, revenue growth, getting into the unit economics. Do I have, a profitable unit economics, or maybe a path to profitable unit economics? Do I have lifetime value or lifetime value over CAC? Am I getting a profitable return for every dollar I'm putting into this machine? What I think has changed is not the metrics, but is how much attention people are focusing on how those metrics are defined and what they really mean. So before, you might be really focused on my LTV to CAC ratio to make sure I'm actually generating profitable customers here. But they may have been like, okay, you're around 1, you're fine, we'll figure out a way to get forward. Now they're saying, well, wait a minute, if I'm paying this of revenue, I want to see you having 2-3x LTV CAC ratio. So I think the bar has moved higher for what people are showing as terms of those metrics being more profitable. And the challenge with that is everybody's realizing that. And so sellers are getting creative on ways to, well, how can I show this better? I can't count the number of IMs that I've seen in the market right now that are quoting unit economics for fiscal or forecasted 2022 or 2023. as their headline numbers of saying, look, we're going to have gross margin or, contribution margin or LTV CAC in 3 years of this.
Right. Don't pay attention to our historicals.
And don't pay attention to where we are today, where we are in 3 years, and anchor on those numbers. And so I think that's, it's a little bananas, actually.
Yeah. That's interesting. Maybe shifting gears a little bit, Yelena, I think you were speaking earlier about sort of the limited bandwidth on the side of the insurers and the pricing dynamics. So kind of as you think about those two things together, are you seeing sort of a world where pricing continues to go up because you have sort of this high demand relative to the supply side? Do you see more providers of RWI coming to the market and maybe relieving some of the price pressure? Kind of what are the expectations there?
Yeah, no, exactly, right. So you have your classic supply demand situation happening where there's just too much demand right now, and as a result, the pricing has gone up. So if you were looking at purchasing reps and warranties insurance in the spring, you were looking somewhere between 2.5% and 3.5% of the limit of the insurance that you are going to be purchasing as your premium pricing. Right now, you're looking somewhere between 3.5% and 5%, which is a pretty significant jump. And for some of the quirkier deals, I've even seen numbers past that. But you have to kind of know that this market, the prevalence of the reps and warranties insurance in the U.S., the market's been around for a few years now, but this is the first time we're seeing sort of this hard market since the beginning of it. The number of insurers kind of remained more or less steady over the last few months. We had, I think, 22 last time we spoke. Now there's one additional one, or two new entered the market, one exited, and I know there's additional ones that are going to be coming in because it is really a cyclical market like this. Now they're seeing the increase in pricing. Additional existing insurers are going to be opening arms that are focus on reps and warranties, or new teams are going to be forming. And I can tell you for sure that if you look on any of the LinkedIn pages for any of the insurers, everyone's hiring. They're all hiring underwriters. They're all trying to steal underwriters from one shop to the other. So there's lots of musical chairs right now. Yeah. But I can tell you for sure they're all expanding their teams. And so come 2020, there are going to be more entrants into the market, or those teams are going to expand. And so we're expecting, if not in Q1, then in Q2, some of the easing in what's going on with the pricing. But the other thing that's interesting, aside from the pricing, the terms negotiation is also becoming a little bit difficult, for the same reason. But what I think we talked about maybe previously in our previous webinar was that everyone was worried about COVID and the effects of COVID. We hadn't really seen that. There's really been not that much of an impact of COVID on at least the reps and warranty side of things. I mean, there's an exclusion for it that the underwriters have put in place once, COVID came around, but there's not been that much of, claims related to COVID or more than anyone kind of expected. And then the other element, I think that also goes to why the pricing is going up is the idea that more and more of the market participants, the ones that are purchasing the insurance, are actually seeing payouts. So insurers are paying claims, and there's more of a history of paying claims, fairly large claims, and that makes the product more attractive to all of these folks that are out there, and also all of those folks that are competing against each other, using the reps and warranty as a method to sweeten that deal when they are vying for the same target. Because remember, again, that product is also used to eliminate escrow or minimize escrow and make the deal a little bit better or palatable for the seller.
No, that makes sense. And this was mentioned a few times, but maybe just to highlight again, private equity and VC activity, kind of in an M&A landscape versus corporate buyers. Certainly, the sense is based on the commentary so far is kind of around, continued focus by private equity, et cetera, to put money to work. Are there other dynamics around VC and PE activity that you're seeing, Jackie and others in the group?
Yeah, I mean, I think it's probably a repeat of what's been said, in the past year or so. I still think PE is, I think it's moving the market for appetite on risk. I think they're like riskier per se than your typical strategic buyer, and so I think strategics are continuing to move that way. I mean, I think 5 or 6 years ago, strategics, Yelena can confirm, but I don't think they were particularly interested in rep and warranty insurance, and I think that's really changed. That's certainly changed with the serial acquirers I've worked with. I think VCs are interesting, right? In that many are really invested in, they've put a bunch of money into companies already, and so they're looking to take advantage of the seller's market and get huge returns. But then they are also looking to reinvest that money. So they're sort of like they're doing both. They're very focused. I have several big VCs on like multiple transactions at a time, and I'm always worried that we're going to like cross emails on different deals, right? And I think it's important to note that VCs and PE shops, I think were really two ends of the spectrum previously, just maybe like 5 or 6 years ago. And I think they're kind of I think they're converging in a way that continues to be interesting, because they're like, oh, people are making money doing this other thing at the other end of the spectrum, and so they're PE people are looking at growth, and VC folks are looking at PE type deals. Right. I don't think that's like anything new, but I do think there's a trend of that, and I think it's continued, and I don't think it's going away.
I absolutely agree with Jack. I mean, that convergence is clear in the market in terms of both moving up and down from VC and PE. And I think one of the challenges it does for the other acquirers out there is it just adds that many more participants in the market on the buy side that are competing for targets. And, sometimes we think about VC as doing fundraising and the growth equity is fundraising, but for a lot of these companies in the later stages, that's taking away from an M&A transaction, because the seller's all saying, I need to raise capital, whether it's to cash out or to continue to grow the business. They're oftentimes somewhat linked, that if you're saying, well, I can raise a lot of money at this valuation, or I can sell at that amount of money, I'm somewhat indifferent if I want to keep going or continue to participate in this business. And so I think it's just added to the competition there.
All right. And what about maybe focusing on early stage companies? I know John and others, you mentioned kind of the fact that you are seeing much more kind of later stage activity here, but with early stage companies, any advice that you may give to buyers out there who are looking at early stage companies at this point?
Yeah, I would say don't shy away from them. The whole market's looking at every asset, so at every kind of stage. And so I think some of the earlier stage companies can show a lot of value and promise in terms of the future. Maybe they haven't gotten the right product market fit or proven everything out, but especially from the corporate acquirer side, if you're managing your strategy around where do I need to be playing in terms of customers, and more often than not, it's product and technology, a lot of those earlier stage companies can fill those holes. I mean, when I talk to my corporate acquirers, they're more often today making a buy versus a build decision, where a couple of years ago, they would have been a little bit more focused on I can build it better than I can buy it. And so they're much more focused on filling in those technology, those product gaps from those early stage companies. I think the one advantage there is maybe you're picking up a little bit more risk in terms of traction and an exact market fit, but your integration is going to be easier, especially from a cultural side. It's much easier to pull in a team of 20 or 50 people than it is to absorb a couple 100-person organization, depending upon your size there. So I think it's certainly worth, especially the corporate acquirers, focusing on and paying attention to and thinking about that.
Yeah, I definitely see that on our strategic buyers. So they are looking at these early stage, even pre-revenue companies. That is not a deterrent for them. Sometimes it becomes a little bit of a problem when you're trying to sell the deals to the insurers and make them understand that it's not as risky as they think it's going to be. But if you can answer those questions and have a good story of why you're purchasing this particular team or this particular asset, how you're going to plan to integrate it into your entity, I think it all works, and there's possibility of getting good support from the insurance market there as well. Just make sure you do your diligence really well and you document your diligence that you're doing, and then make sure you have, all of that documentation and you can answer all of those questions, and take a look at the underlying insurance on the target to make sure that, they're covered for things like cyber, which has been at top of mind for a lot of the acquirers.
Yeah, great. And I'll just jump in on diligence there. I think I mentioned this earlier, right? That or some of the early stage companies, maybe they haven't traditionally thought they were going to be in this process right now, or it's not economically feasible to have built out a whole data room, or they've done 5 financings that they already have all of these documents in place. And I think that it's hard, right? Because there's sort of this idea of, I really want to go fast. It makes sense, it's seller's market, but also in order to do the diligence, it's going to take some time. And so I think, there's competing, narratives there. And obviously I think it's just a matter of trying to be flexible and realize that, it's not going to be perfect, and it's not going to be like, oh, that's great, everything is solid and golden, and we have all the risk compliance that we need, right? Early stage companies, it's not economically feasible for most early stage companies to like comply with GDPR in every single situation.
No, for sure. Well, great. So maybe I know we're heading into Q&A, so maybe one last sort of combined question, if you will, to go around the table and kind of get everyone's thought on, one, kind of your view of what happens, call it, in the next 2 quarters, and 2, if you have any sort of parting words for the audience, any piece of advice for buyers out there. Maybe starting with you, Jackie.
Sure. So, I mean, I think my general prediction is that it's unless there's something just absolutely crazy that happens, I think we're going to be having the similar conversation in the next 6 months. I think maybe more so leaning towards SPACs, as so many of them, as Yelena said, are up against that timeline. It will be a much more, rigid timeline at that point. So I think the deal flow will continue. I certainly don't see it stopping. And then in terms of parting words, I just said this, but I'll say again, I think being flexible here is one of the most important things. I think trying to drive the process is really important, right? But everyone is hopefully doing the best they can. And I think it's not going to be the same, if you did a deal a couple of years ago and this is your second exit or something, it's going to be different. And I think you just have to realize and set your expectations and set other people's expectations accordingly. But I mean, I think, just realize it will get done, but it's probably going to take longer, and it might cost a little more, unfortunately.
Great. And John?
Yeah, I mean, I don't think I have anything to add with where I think it's going. I think it's the same. I think it's going to be status quo for the next, 6 to 12 months, unless something massively changes. And so if I'm thinking, about my buyers that I advise, it's competitive. We've been talking about that the whole conversation here over the last hour, and the speed and the pace. It's different than it used to be. Today, you need to be going in with a unique point of view about why this asset is going to be accretive to your business. And you've got to get conviction around why that is. And in order to do that, you've got to go deep on the diligence. You've got to really understand the mechanics of the business today. And more importantly, what's it going to take to transform that business into what you need it to be tomorrow? Because that's how you're going to win in this market is, frankly, you're going to need to outbid everybody else. And the only way you're going to do that is by really having conviction of the value in this business. So get there.
Yeah. Yeah.
Well, John and Jackie covered everything I was going to say. So I don't have much to add, but I'm just going to reiterate the fact that I think SPACs are going to be happening. It's going to be a crazy market going into 2022. And everyone really pay attention to your diligence, because it's going to be helpful for everything that you do in the future, whether it is getting the deal done and closed, or integrating that target into your structure and going forward for future deals and making a good mark and a good name for yourself out in the market.
Fantastic. Some very good words and good and sound advice from the group here for buyers like myself and others. So yeah, I think with that, it feels like a good time to turn to the Q&A portion of the session from the audience. I know we have a few questions that have been submitted in advance of time, and so we can get started with those while folks add to the queue on the question list here. But please, for the audience members, please do go ahead and submit your questions at the bottom of the screen. In terms of the pre-submitted questions, I think one of the ones that was raised and probably comes into play kind of is you think about kind of the early stage deals that were mentioned where you are buying a technology, where you're buying a team that supports that technology, or even for larger companies where you do have the employee base as or the leadership as sort of a key component of the transaction. What are you seeing out there? And this is for open to the group, but what are you seeing out there in terms of retention and other mechanisms that are being put in place by buyers to ensure that that's a sort of a smooth transition?
Yeah, I mean, I think retention of, if it's an acqui-hire type of transaction where I really need a team or a product, the people are the most important asset there. Mm-hmm. And so what I'm seeing buyers do is put in very generous retention packages. Mm-hmm. In some cases, that means there's a little bit of carrot and a stick that goes here. The stick is sometimes they're making the senior executives roll over their equity. So instead of them getting a massive payout for the founders or the very, very senior folks, they're making them roll over into a new, whether it be equity or cash plan that's going to vest over 3 to 5 years to kind of keep them there so that they still get the overall economics, but the buyer's getting some of the assets there. And then second, it's about giving really generous retention packages to the rest of the folks. I'm seeing deals where we're talking about engineers in the work, if you just divide deal price by engineers, it's tens of millions of dollars an engineer. And you gotta, if you're paying that much, you're going to give them a retention to stick around. And so it's about making it really lucrative and then giving them the culture that they need, making sure that that culture transition happens. So they're just not thrown into a pool that they don't feel they belong.
No, that last point is very important. I think it's probably the toughest one. I think the others, kind of the metrics around retention bonuses, et cetera. That last part, much of a, finer point to figure out by the deal teams and HR, et cetera. Yelena, Jackie, anything else you would note on that topic?
I think I've certainly to that last point that you mentioned was important and difficult. I have seen more conversations about it and people trying to put it on paper, which I find very interesting, of like, what are my hours going to be and what am I allowed to do? And, not just like the non-compete itself, but the like, what can I do in my spare time? Can I still have this other thing that's like my hobby? That it's like a business, right? I'm not saying like you can't go rollerblading, but like, I want to be able to do this thing. And I think it's really, people are, whereas I think a lot of serial acquirers are like, absolutely not in the past few years, like we're not gonna put that into wording. I think there is a way to really almost try to negotiate like how the culture is going to work, which I think it's really interesting.
Yeah.
And John mentioned rollover. I would just keep an eye on the percentage of that rollover when you're working on the deal, because sometimes that runs into some issues with the insurers. They don't necessarily want to go too high, or if you go too high, they might not want to cover it 100% if there's a claim.
Right. A fair consideration. So we do have a question around sort of deals falling apart and kind of what are you seeing out there as sort of the common reasons that deals are ultimately falling apart? And John, I know you mentioned a little bit of this earlier around valuations, but sort of other dynamics to think about here.
Yeah, I mean, I think price is certainly one of them, but price just means somebody else got the deal. So if the question is why deals fail in general, I mean, if you're the buyer, maybe you get outbid by somebody else, but somebody else walked away with the prize. It really sucks to come in second place. It's probably the worst place to be in an M&A world, is having gone through the whole process and gotten almost to the finish line. But when deals fall apart, I think it's really because the sellers have too high of an expectation of the value of their asset. And I've seen a number of deals just fail in the market, or, hey, I'm seeing this target again 6-9 months later, it still hasn't transacted. And that's because the seller is being a little bit unrealistic in terms of what they think their value is vis-a-vis the market and vis-a-vis their quality. And that's where that disconnect is where I think deals just absolutely fall apart versus somebody else winning because one buyer didn't pay enough.
Yeah.
I've seen a few deals. I wouldn't say fall apart, but they just don't get started. I think there's this expectation that folks really, even though they're flush with cash, people love to pay in stock. They feel like it's a great thing to do. And everyone wants to talk about tax deferred reorganizations, and they don't quite know what that means. And then once they start, and so like you'll have, as you do, right, you'll have an LOI negotiation. Maybe the lawyers are involved, typically not, or the tax advisors more likely, right? And then you get an LOI and you're like, you can't, it can't be tax deferred. That's just not actually possible. And so I think that you just have, you hate to be the deal killer, but you kind of have to say, look, like that's going to have to be renegotiated. And if that is the actual key to the deal, then it probably can't be done.
Right. And anything, Yelena, from your perspective in terms of, deals that just don't make it through kind of the rep and warranty insurance process?
I can't say that I've seen too many of those because once we get going, we get it done. Right? One way or another, if I have to beg and steal and get it done, we will get it done. I hear you. But I mean, I've seen deals when we were talking about getting into it. I mean, an auction sometimes the buyer just doesn't get the deal at the end, somebody else wins. So that's a possibility. From a rep's perspective, if you walk down a little too far on the rep's process and you are out of exclusivity, there's additional fee associated with that. So you really need to be very careful. Those fees could be in hundreds of thousands of dollars, again, because the bandwidth is so limited on the underwriter side that they don't want to start the process unless they know they're actually going to be working on this thing. So if you break it midway, you're going to be paying those fees. So that's one example. And the other is if the parties just decide to go IPO or SPAC or some other direction, and they just realize that that's a better alternative for them. So we've seen a couple of those as well.
Yeah, no, that makes sense. And just going back to our list of sort of pre-submitted questions, one that sort of stood out to me, I was curious about is whether you're seeing any sort of new technologies or solutions around due diligence that's making the due diligence process a little bit smoother, any sort of SaaS platforms, analytics, et cetera, that is streamlining that process, which can otherwise obviously take quite a bit of time. And I know at various points you spoke about some of the issues for companies in getting that through that process.
Yeah, I mean, I think that there's all sorts of technologies out there, and I think some of them are great. And I think it as with anything, I think it requires folks to commit to it and to get everyone lined up to commit to it, right? So you can't have your lawyers doing it, but then not have your tax advisors or not have your financial advisors. So I think I do think that there's some awesome legal technology out there. It continues to get better. Folks are, it's a huge, I don't want to say it's a huge burgeoning market, but it is, right? For what it was 5 or 6 or 10 years ago, I mean, it's just like, incredible multiples of companies out there, and they're doing great things, and there's definitely a need, but it's I think no matter what, whether it's diligence or filing documents, it just has to be lined up and everyone has to be on the same page, because if it doesn't, then you've got 1 or 2 people off and it falls apart, and it's not helpful for anyone.
Yeah, I mean, that's right. Like I think about from the diligence perspective and more of the execution, I would say the tools haven't changed in the last 5 or so years. I know that some of the big data room providers and others are coming up with tools, but you end up kind of in this lowest common denominator, which everybody defaults back to exchanging Excel sheets and setting up a Zoom instead of a audio-only teleconference. I mean, that's been the biggest change. Otherwise, everybody's still kind of just exchanging trackers and Q&A lists in Excel. And I would love somebody to come up with a full suite kind of workflow process that all the advisors would work into. And as Jackie said, it needs the buy-in. And I just think what you end up finding is you just don't get that buy-in. And so you see some of these tools come into, especially like the data room providers for Q&As and other sorts of items, and nobody ends up using them. It's kind of sad.
I can vouch for that as a buyer. Certainly exchanging Excel trackers is still the name of the game, at least for some.
It hasn't changed.
Many years. Excellent. Well, good. I think that we have time for just one last question, and then we'll wrap it up. The question that's submitted asks kind of if there's any advice you would give for very first-time strategic buyers who haven't done this before.
First-time strategic, I love those. I work with a lot of them. No, it's great. It's great because once you get them through the process and you explain it, it's like a light bulb goes off in their head. And they're like, really? We could do this? It actually works. Yes, it does. And so, but the advice is start early, pull in your advisors at the beginning of your process so that you understand what they need from you and they understand what the timing is. And then that will smooth out a lot of that process for you, and a lot of those bumps. And like Jackie was saying earlier, flexibility, just, kind of roll with it. Take the advice of the folks that you've selected to be your advisors, because they've done a lot of these deals and they will help you through it. But yeah, it's great working with first-time strategic buyers. It's, they go for it once they understand how the process works. I would want to say though, when you are buying those targets, make sure that they either have audited financials, or if they don't have audited financials, that you go out there and get your quality of earnings commissioned and ready, because that now takes, John can probably attest to this, takes a lot longer than it used to. And if you're getting your reps policy in place, you will need that if there's no audited financials as part of the deal. So that will slow you down. So make sure you get on that early. Call John and then call
Absolutely.
And I think, to that, yes, I agree with everything that Yelena just said. What I would say, especially for first-time buyers, is be prepared for sticker shock. Not necessarily at the price of the assets, but for the transaction cost to get it done. All of your advisors are very expensive. And I don't say this selfishly, but don't be cheap. That's where problems come up down the road, is when you skimp on advisors or legal advice or tax advice, or don't think something's relevant. Dollar of good advice is probably worth 10 down the road. And so it's going to be really expensive if you're not used to paying, M&A kind of advisor prices. But it really is worth it. They're here to support you through a transaction. It will really help you there. I think the second piece and the last one is, don't become too emotional about the deals. Not every deal gets to the finish. If it's not right, walk away. These can be transformational transactions that can change the shape of your company. If it's not the right decision, don't do it.
Yeah, I think that both John and Yelena gave good advice. The only thing I think I can add is, be cognizant of the deal terms that you're setting, particularly if you're going to publicly file something, because you haven't thought about this before, but if you publicly file a document, the next time as a serial acquirer you go to do a deal, if you've given really seller favorable terms, that's going to be asked again, right? And so if you can avoid that, obviously it's a seller's market right now, and you can 5 years from now say, look, like it was a different time, but I think that does come up a fair amount. And, it's something to think about. I wouldn't say don't do the deal or something, but it's something to think about as you're negotiating terms, particularly if it's going to be, publicly filed.
Yeah, very good advice all around. A big thank you to all of you, John, Jackie, Yelena. Thank you so much. This was very insightful and all very relevant topics for today's buyers. With that, Colin, I'll turn it back to you.
All right. Well, to echo you, Saran, John, Jackie, and Yelena, thank you so much for sharing insights. And Saran, thank you for sharing insights too. Really appreciate you all. For those of you who are still on the call and you didn't get your questions answered, and I know we've had a long action-packed day of M&A activity today. We're going to launch a final poll. Just let us know if you want a follow-up meeting, or have any other additional questions with our partners. But again, to our last panel, Growth Through Acquisition, thank you so much for joining us. And for everyone in attendance, thank you all for attending. And we look forward to seeing you all online very soon. So thanks again for joining us, everybody. Have a good one.